The first week of 2024 is almost in the books. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlet Fu.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the United States. We have a lot of economic data today and a very conflicting signal on the market, but we do have green on the screen on an S&P 500 that is flirting with its first week of declines. For 2024, its first week of declines in weeks. But today, green on the screen, 0.2% higher on the day. We're looking at a dollar spot index. I point this out because this was an index that shot higher and then shot lower after we got that ISM data. Some questions about economic growth here in the United States, and we will talk just about that in a bit. We have the two-year yield also roughly flat on the day after those mixed signals in economic data. And Brent crude back on the rise, 1.7% higher on the day, ending the week higher, above 78, flirting again with 79. And again, that oil price movement here we're seeing on the week, Scarlett, really gives you questions about what that inflation picture looks like moving forward.
Yeah, you hinted a lot at conflicting economic data. For a data-dependent Fed and market, which data point do you go with? The hard data show blowout payrolls in December, as well as a pickup in wages, but it's backwards looking. The soft data paints a different picture. Employment in the service sector, which is the biggest part of the economy, is shrinking the most in 3 years. So which is more relevant? Are they in conflict with each other? Is the soft landing narrative still intact? Now, whatever you make of this macro backdrop, companies and the people that run them need to plow ahead. And that means providing investors with a status update. The KBW Bank Index today climbing to a 10-month high as lenders get ready to kick off the fourth quarter corporate earnings season next week. First up is Jefferies on Monday, followed by JP Morgan, Wells Fargo, and Citigroup on Friday. And Sonali, these are all the different dynamics pushing and pulling the price action across asset classes. How are markets digesting all these different inputs?
Yeah, they're certainly digesting them in one way or another because we have those rate cut expectations really not moving much at all, even though economic data is coming in quite hot. Remember, we had that ISM data we were talking about that showed some slowing of the economy. When you look at the payrolls, what's fascinating here is that you are looking at some of the biggest payroll gains we've seen in several weeks. And in addition to payrolls here, you really the unemployment rate only slightly ticking up. You have also wage gains, and those parts of the economic picture draw a big question mark. There are even some investors who believe you could start seeing rate hikes if the economy stays this hot. Of course, wages themselves are a big picture of the inflationary story, Scarlett. But when we're seeing that converse softening of certain economic data, you think ISM, then you think about the CPI print next week and inflation and how important it'll be as investors start to maybe finally sort of start to recalibrate their interest rate expectations heading into the end of the year.
It is an ever constant recalibration. All right, so let's kick things off now with Tom Porcelli. He is chief U.S. economist at PGIM Fixed Income. And Tom, there's a lot to get through right now. I guess I want to start with the big data points we got today that Sonali just talked about. Is the monthly jobs report, in which we saw an increase of 216,000 jobs in non-farm payrolls and the unemployment rate staying stable at 3.7%. in conflict with the ISM report that shows services employment shrinking the most since 2020?
Yeah, so great question. And of course, as always, good to be with you. Look, I think actually they're pretty consistent. And so hear me out. I think what you need to do, and this is always true with the payroll report, right? The payroll report is like it's a mess of moving parts. And so you need to really sort of drill in. And when you drill in, what you actually see is that there's underlying weakness. I mean, you can't take at face value 216,000. I think what you need to do is you really sort of, you need to sort of strip out a couple of things. And the thing that we like to do is we like to look at something we call cyclical employment. Excuse me. Cyclical employment is basically private jobs, ex-healthcare. And you strip out healthcare because healthcare is not cyclical, right? It's very secular. Mm-hmm. And when you do that, what you see is that we actually only gained 100,000 jobs. That was this month, by the way. If you look at the three-month average, we're only gaining about 40,000 jobs. So I think beneath the surface, things were looking a little softer. And in fact, I would even say that was true on average hourly earnings. I mean, again, I've said this many times, and people that know me well know I absolutely hate average hourly earnings, mostly because I think it's just a completely incomplete measure. I think a much better way of thinking about it is to look at like average weekly earnings, right? Because it'll take average hourly earnings in combination with the number of hours worked. And what you see on average weekly earnings is that it only rose, 0.15% month on month. So what I would argue is that this report is very consistent. This payroll report is very consistent with this continued slowing that we've been witnessing in the labor backdrop for many months now. And so when I think about that in the context of ISM, particularly the employment index within ISM, look, that was a very big decline. I mean, one of the biggest, outside of the pandemic or even the GFC. But what I would say is the rhythm of both of those reports, I think, is very consistent with the labor backdrop that's slowing down.
Okay, so big picture, the labor market is slowing down. Nevertheless, we have seen the economy hold up better than so many people had expected. You just think back to the same time last year when everyone was predicting a recession. How much have easier financial conditions, underpinned, of course, by expectations of rate cuts this year, contributed to this unexpected resiliency?
Yeah, look, what I would say, and I was just having a conversation with a buddy about this. I think financial conditions are giving way too much credibility. I mean, I think they're important to get a sense for the tone in the market. I think in terms of its ability to tell us where the economy is going, its track record is a little more spotty than I think is appreciated. What I would say is this. People last year may have been talking about sort of a backdrop that was going to be, sort of much weaker over the balance of 23. But, the Fed hadn't really embarked on the aggressive hiking cycle. We hadn't really felt the effects of any of the tightening that was put in place. So it's a pretty big different backdrop now. And if you look at real Fed funds, right? So Fed funds adjusted for inflation, you're pretty aggressively tight at this point. And I think that's what's going to sort of continue to put the brakes on economic activity over the coming year. And so when I think about the coming year, it's easy to make the case that you're looking at about 1% growth. I guess that would, be classified as sort of soft landing. But I think that distracts from a reality. If you get down to 1% growth, the unemployment rate is going to rise. It's going to rise at least 100 to 150 basis points. That's going to feel pretty darn recessionary to a lot of people.
So let's talk about inflation for a second here, because on the other hand, you do have wages still on the rise. And so if you think about the inflationary forces that are under the surface, nothing to say of gas prices or oil prices, rather. Yeah. How much of a risk is there that the Fed is still going to have to fight harder? Yeah,
so look, I think the narrative coming out of the Fed, so for starters, we expect inflation will continue to drift lower. We think that there's a sort of a lot of disinflationary pressure, obviously particularly emanating out of the goods space. And so we think that inflation will look much better. And I mean, let's be clear, it already looks a lot better. But we think it'll continue to look much better as the year moves on. But I think for the Fed, I mean, it's funny, when that payroll report came out this morning, as soon as it hit, I was like, wow, the Fed's going to love this number. Not because they think that this is an economy that's churning out 200,000 plus jobs on a consistent basis, but because I think it gives them the cover to continue to push back on early year rate cuts. The possibility of the Fed going early year, January or March, I think the hurdle is high to see that materialize. So I think what the Fed is going to wind up doing is they're clearly not going to get a lot of help from this payroll report, since cold water was thrown all over it in the wake of ISM. So what I think they're going to need to do is really come out and push back hard on this early year pricing of cuts. Yeah. And the way that they do that is to basically say, look, we still have a lot of work to do from an inflation perspective. The labor market is seemingly in a good spot. But I think what's going to get them to turn and ultimately wind up cutting, which is what we expect in Q2, is that narrative will only last for so long because labor will continue to slow.
All right. It's something we'll watch for, of course. Plenty of Fed speak coming up in the days to come, and we'll hear if they do indeed point in that direction. Tom, really appreciate your joining us. Have a great weekend. Tom Porcelli of PGIM Fixed Income. We do have some breaking news here. Wayne LaPierre, according to the Wall Street Journal, is resigning from the NRA, the nation's largest gun rights group. This comes on the eve of a civil trial in which the New York Attorney General is looking for his ouster, as well as financial penalties for years of alleged corruption at the nonprofit organization. LaPierre is 74 years old, and according to the NRA, he is citing health as his reason for stepping down. The resignation would reportedly be effective on January 31st. We'll have more on this. This is The Close on Bloomberg. You have stock indexes moving modestly higher on this final trading day of the week, and you have yields moving modestly higher as well. But that doesn't really tell the whole story of what we have been dealing with today. Let's bring in Keith Lerner right now. He is Chief Market Strategist over at Truist, and there's a lot of data for markets to digest, but right now we're kind of standing still in terms of price action. Let's step back for a moment here. As we came into 2024, was there a rotation taking place already, or have the moves that we've seen so far really indicated a knee-jerk reaction where we're buying last year's losers and selling last year's winners?
Yeah, well, first, great to be with you. I think it's the latter. We have to remember we had a 9-week winning streak to close out the year, and that's the longest since 2004. There's also a lot of investors that had a lot of gains in these big mega cap tech stocks. And, as I'm talking to clients and folks, some people wanted to wait to the tax year to change to book some of those profits so they could defer a little bit longer some of the gains there as well. So I think we're seeing, a bit of rotation, some profit taken. And also the market, on some of the measures that we look at, got the most overbought that we've seen in some time. So I think it's normal to see some type of consolidation, some digestion period. But I will say that strong momentum that we saw at the end of the year, we actually tested similar conditions. When you look out 6 to 12 months, that's typically a positive sign. But again, some digestion after that big ramp up makes a lot of sense to us.
Yeah. So, okay, there was overbought conditions at the end of last year. What does that mean for sentiment, particularly individual investors, and how that sets us up in terms of responding and positioning against positive surprises or negative surprises?
No, it's a great question. So I'm gonna talk maybe the two things, sentiment and momentum, and they're kind of in opposite directions right now. I will say the sentiment picture, the way I think about sentiment is about expectations. Part of the reason why last year was such a strong year is we came into the year after a really tough market of 2022, and sentiment was very bearish. So the bar for positive surprises was really low. And what last year we saw the economy more resilient, earnings more resilient, and that helped propel the market. This year, unlike last year, unlike the prior year, you had a big ramp up in the stock market, and sentiment is a lot more optimistic. So that bar for positive surprises is also harder. So that just makes it a bit more challenging to begin, right? Also, the first part of an election cycle year also tends to be somewhat choppy in that first quarter. But again, if you look back at the momentum itself, when we look at something, the relative strength index, which is a fancy word for momentum, it's on the Bloomberg. It hit above 80 for only the fifth or the 16th time since going back to 1980. And when we test that out a year later, the market's been up 13 out of 15 times with above average gains. So the way to think about that is, again, some give back, some, back and forth, some choppiness, but the underlying trend is still positive. So we would stick with that trend and look at pullbacks as opportunities.
Now, I'm curious about how much you think the market is vulnerable to the rate cut expectations. If we don't see the Fed cut as much as investors currently expect, do you think that there is a bigger drawdown at play given how much we've seen the market rally into the end of last year?
Yeah, it depends on the drivers. I mean, I would take a more solid economy with less rate cuts as opposed to much more rate cuts because the economy is weakening. I mean, we cut rates a lot in, after 2007 into 2008. 2001, and that didn't help the market. So, first of all, I think the market was pricing in too many rate cuts before this relative to where the Fed is. And I think, the Fed is around 3 cuts. The market was at 6. Somewhere in between makes a lot more sense to us. And again, I think maybe you get a little bit of a hiccup, but I think an economy that, continues to grind forward with some rate cuts, I think is overall still a good backdrop. Again, I would be more concerned that we actually have to do 6 rate cuts because the economy is slowing. And that would be probably because more recession fears start to come up again.
You kind of think about the recent bids that have come into things like the Russell Value Index or other unloved stocks within the S&P 500 even, and you have to wonder whether that market breadth can be maintained in that kind of scenario if the economy were to land a little harder. Do you think that investors are looking past the Magnificent Seven anyways?
Well, we did see toward the end of last year, breadth broaden. So the story last year, as we all know, was this technology-driven market. There was only 3 sectors in the S&P that actually outperformed the S&P, which were all technology-related. We saw that big move up. But I would say this, even with that big move up, the average stock or the equal weight S&P index trailed the traditional market cap index by the most since 1998. So what I think this year is it's unlikely that these Magnificent Seven are going to have that same type of dominance. So I think the market will be broader by definition. There'll be less concentration and opportunities below the surface. So as an example, what we're doing with our portfolios is we have traditional S&P exposure. We have exposure to that equal weight index, which is somewhat cheaper and has some exposure to some of that cyclical areas of the market as well. And then lastly, I do think, small caps, they were trailing by over 20% at one point last year on a one-year trailing basis. They got to the lowest relative valuation since 1999. So they went up 25% since the October lows. Now they're giving some of that back. I think for investors, as small caps pull back, if you're underinvested, especially if a longer time frame, I think they're still somewhat attractive.
Keith Lerner, Chief Market Strategist at Truist Advisory. Thank you so much for your time. Now, it's interesting, Scarlett, we think about the markets right now, and we think about how interesting just the equity markets are.
Yeah.
And you think about the last year, and the bond markets were, of course, more volatile. This year, the big question is, does that volatility start to finally overtake the equity markets more than they have in fixed income?
Well, today they certainly are. You look at what happened with the 2-year yield and the 10-year yield. I know at this moment, you look at the net change, it's not a whole lot, but my goodness, the moves just within an hour, 2 hours this morning, 15 basis point move, 17 basis point move. You can't make this stuff up. You can't make this stuff up. And you have to wonder how you trade in that type of environment when the intraday volatility is so significant. You think about that 10-year yield flirting with 4% once again. We were talking with a guest a little earlier about how 4% is fairly valued. If you believe that, then what's in a day? What's in a day? I mean, the thing is, equities depend on where bonds are trading to determine value. So how do you price stocks if you can't price bonds right now? And the other thing I love is kind of the intraday volatility you're seeing, not just in bond markets, but also there in currency markets as well. Absolutely. That all plays into multinational companies, including the likes of Apple. Absolutely. And Apple, by the way, is at risk of losing its title as its world's most valuable company. We're going to explain which company is gaining ground on the iPhone maker. Stick with us. We're going to talk about Apple's struggles and the rebound we're seeing today. But of course, a lot of criticism on the company this week. That's up next. This is Bloomberg. Apple is off to a weak start this year. Shares are lagging after 2 downgrades, putting its long-standing status as the world's most valuable stock by market value in jeopardy. Now, we also have a New York Times report talking about a potential Justice Department investigation that is moving closer to its late stages. We're going to bring in Bloomberg Intelligence senior analyst Anurag Rana to join us to discuss some of the issues Apple is facing, both with its products and the economy, as well as legal challenges. If you had to choose between the two issues, which is a bigger one?
I mean, I think the product challenges in the near term are the bigger issue in terms of growth rates, because that's going to be another year of, you could say, muted growth rate for sales. But, I think it'll come back in a couple of years. It'll come back in a couple of years. How extended did expectations get for Apple? We talked a lot with just in the previous block about how share prices and the indexes were overbought, and Apple, being a member of the Magnificent Seven, certainly getting caught up in that as well. Yeah, and if you go back, when Apple reported their results on November 2nd, they did issue a weak guidance for the next quarter, and China was the big factor over there. Now, I'm just surprised that all of these things are now shaping up in terms of the stock reaction on Jan 1st, which I think, as your guest mentioned, had to do something with the rotation of that. But the news was already out there that, things are not going to be that good in this December quarter for them, and they had guided to it. So I'm a bit puzzled, but I think the stock reaction is different than the fundamentals of the company.
Now, fundamentals of the company, I want to go back a little more to that potential Justice Department probe upcoming for Apple and its devices here. The New York Times reporting that investigators specifically, Anurag, are examining how the Apple Watch works better with the iPhone than with other brands. They're scrutinizing Apple's payment systems and how it blocks other financial firms from offering similar services, according to the Times. Can you speak to Apple's ecosystem here and how much it matters for the company's success?
Yeah, again, I have not seen the case, but I would argue on the other side. Apple has had a closed system ever since the beginning of their Macintosh operating system. They do not allow other people to get into the operating system and muck around and basically get viruses in there. That's really the hallmark of Apple. It controls everything very strictly. And I'm surprised to hear about some of these. Now, the payment side is different because if they don't allow anybody to use third-party payments, and I think a lot of that is getting addressed with the Digital Markets Act that's coming out in Europe. But Apple is a closed system. I mean, that's the end of it in my view.
All right, Anurag Rana, really appreciate your joining us. Anurag Rana is Bloomberg Intelligence Senior Analyst in Chicago. We want to switch gears here and get back to that breaking news we told you about. The longtime NRA, National Rifle Association Chief Wayne LaPierre, announcing his resignation. This comes, of course, just days ahead of the civil trial in which the New York Attorney General is seeking his ouster. Bloomberg's David Weston joins us now with more. Wayne LaPierre has run the NRA since 1991, and by all accounts, he's done an incredible job pushing his agenda. So he's kind of resigning with his job done, but also with his tail between his legs.
Well, I think that's well put. Pushing his agenda, I think that's probably exactly right. For the organization, less clear, because in recent years, the membership has declined really precipitously, and their revenues have declined precipitously. They've really come under real storm, and it's a less organization today than it was 5 years ago. So he's certainly been pushing his agenda, but it's not been as successful, in part because of some of the things going on here that Letitia James, the Attorney General of New York State, has been pursuing with him.
Well, can you speak to that part of things? This is all on the eve of a civil trial here. What does it mean for Letitia James's push?
Well, on the one hand, she started out wanting to dissolve the NRA, and she didn't get that. The court said you can't do that. You got to take a less restrictive alternative here. So she went after Mr. LaPierre, as well as 2 or 3 of his colleagues. But basically what she said was they were not using the funds for charitable purposes. It is a charity, actually. We might forget that NRA is a charity. And they were using it allegedly for a lot of different purposes, including for a lot of private jets, for a huge shopping spree at Xenia out in Los Angeles for Mr. LaPierre. Those are the allegations in the lawsuit. And so the claim was, you're sort of using this to some extent like your personal piggy bank, not for charitable purposes. That was the allegations. That's what they're going to try to seek to prove. By the way, this was not, as I understand it, part of an overall settlement. When I first heard it, I thought, oh, maybe this is settling the case. I now read from other news organizations, it's not part of a settlement. So that trial can still go forward against the other people. And also there are money damages being sought from Mr. LaPierre.
So if Wayne LaPierre's resignation was one of Letitia James's goals, and that's being taken away, and dissolution of the group is not likely, what else is she gunning for at this point?
Well, she wants money back. She wants to go after some of the people, but she's clearly diminished the scope of it. I think the really interesting question for me and for a lot of people, because he has been such an institution when it comes to gun legislation, what will it be like now? I mean, how much of it was because of the NRA and Wayne LaPierre, as opposed to other people, whether people stepping in? I mean, we have to bear in mind, through the last several Supreme Court nominations, one of the issues is where do they stand on guns? They have a say about who gets nominated in the Supreme Court, certainly over legislation. It's a lobbying organization. It's been perhaps one of the most effective lobbying organizations in Washington, at least in the past.
Bloomberg's David Weston, we thank you for your time. Stick with us. More markets next. This is Bloomberg.
This is the countdown to the close. Equity investors looking for the first gain of 2024 may get their wish, because right now we do have modest advances in the S&P and Dow and NASDAQ. But you look at the Treasury market, a lot of movement, but not much to show for it when it comes to the actual prices. Look at what's going on in commodities, though. You have oil prices levitating, WTI approaching $74, above 73, set to end the week higher following output disruptions in Libya and increased Middle East tensions. Copper prices currently lower by 0.8%. Gold marginally higher, though it is set to close the week down, the first weekly drop in a month. And I wanted to mention soybeans, Chanali, traded in Chicago. They're set for their worst weekly drop since September. The issue here seems to be plentiful supply. You have a combination of a lack of Chinese demand, plus rains in South America is improving crop prospects, so no shortage of supply there right now.
And let's switch back to Jobs Day because it's been a big day and we're going to focus on now the future of work because the Boston Consulting Group is out with a survey that points to the coming year as a pivotal time for companies. AI is transforming the workforce, and at the same time, most companies don't have all the talent they need to meet growing challenges. Joining us now is Rich Lesser. He's the global chair of the Boston Consulting Group, and it's a fascinating time to talk about AI because as much as we talk about AI, the full effects have not been seen. What does AI really mean for the job force ahead?
So I think there's some things we know for sure and some things we don't know. What we know for sure is that the pressure on reskilling and workforce planning inside companies due to AI is going to increase dramatically in the years ahead. I mean, generative AI, particularly when you combine it in some areas with predictive AI, the AI we've had for years, is going to really reshape what it's capable of doing and therefore what we need employees to do. And in many cases, whereas the older versions of AI would touch 5 or 10% of a workforce, Gen AI can touch what 50% of the workforce does. That puts enormous pressure on companies to really invest to reskill their employees and to invest in their workforce planning, to think about what are the skills they need, not just next year, but in the years ahead.
Do you see companies?
Big question,
Rich, do you see companies really making that investment, though? I mean, we're coming off years of inflation where margins have been pressured, costs of borrowing are rising. Do they have what it takes to reskill the workforce, or is the near-term pressure going to be just more job cuts as they use AI to really supplement certain activities?
So there is a question, and you're absolutely right to point it out. If you roll this forward 2, 3, 4 years, will we see areas where people just need fewer employees? But I do want to challenge the original thesis. I think companies have been remarkably focused on retaining talent through a very uncertain economic period where a lot of the headlines were all negative until really just the last 3 to 6 months when people started to see a soft landing was possible. That was something we had said even in 22, but broadly the news was negative. And despite that, we didn't see massive layoffs. I think most companies realize that attracting and retaining a great workforce is fundamental to their success. So now you get to the question, was Gen AI can pick up more and more tasks? Will companies repurpose people towards higher value-added activities? Will they decide they need new and different skill sets, or will they just have fewer people? I just want to remind us, it's exactly a decade ago, I was heading off to Davos, and everybody was going to talk about how digital was going to lead to massive job cuts. And every conversation I was in Davos was how much digital was going to, transform the workforce and eliminate jobs. And it's 10 years later, and in many places we have a shortage of workers, not a surplus. So I think we can be a little more optimistic maybe than some of the headlines suggest.
Right, the idea that digital didn't necessarily kill jobs, but it changed the kinds of jobs that are in demand. So as companies look to train employees for new capabilities, will that training still necessarily include the traditional criteria, the traditional credentials of, say, like a college degree? Given how politicized the elite schools have become, will employees seek credentials other than those expensive degrees?
I do think companies of many varieties are recognizing that jobs that we traditionally said had to have a college diploma, you can focus more on skills and experiences to bring a wider range of talent. And they've needed to do that because there have often been talent shortages in different areas. So if you were forced to rely on a very narrow set of a workforce, you're likely to come up short. So I am encouraged that one of the things that Gen AI and AI more generally will do is enable us to upskill and reskill people much more effectively. And that will make more people able to qualify for jobs that 5 years ago we'd have said, oh, they don't have a certain degree or a certain background, we can't use them. I'm quite encouraged about the opportunities there.
What about generative AI and the impact on the competitive landscape? We're starting to see signs of M&A picking up. Certainly, there's been a lot more talk and speculation of deal making in the last few weeks as compared to the most of 2023. Does the deal making that we're likely to see in the weeks and months ahead, is it more offensive or is it more defensive?
I think we will see more offensive-oriented AI. And by offensive, I mean AI design. I mean, not AI, M&A. I think we'll see M&A geared towards future growth more than anything. I think most companies feel like they're pretty productive right now. They don't need to do deals just to rip out cost or to pick up a point or two of today's market share. What they need are the technologies and the customer relationships and the business models that will allow them to drive growth in a world of very rapid change, and not just due to AI, due to synthetic biology, quantum computing, physical sciences that are continuing to make rapid progress, climate tech. I think in that world, as companies look ahead, they will be looking for acquisitions that give them the underlying strength and the technologies and the people to be able to grow. And I do think with a plateauing of interest rates and hopefully a decline before too long, and a lot of money sitting on the sidelines, both on corporate balance sheets and in the private markets, that combination will spur a rebirth of M&A. Of course, the regulatory constraints are tough right now, so that doesn't make it easy either.
Rich Lesser, Global Chair of the Boston Consulting Group, certainly an interesting time for transformation ahead. Now, still ahead, Peloton and TikTok, they're pressing play on a new deal to launch a fitness hub. More on why analysts call this a positive move, but urge investors to proceed with caution. This is The Close on Bloomberg.
It's time now for our top calls. It's a look at the day's top recommendations on and the movers that have resulted. Let's start with Palantir, because a downgrade to underperform from hold by Jefferies analyst Brett Thill is moving the stock right now. Price target has been trimmed to $13 from $18, and Brett Thill is calling the shares overhyped on artificial intelligence. Now, he does expect 2024 to be a positive year for software, but he warns of seasonal black ice ahead for Palantir. The stock currently down by 1.4%, and I misspelled that. It should be Story. Next up is PayPal, cut to neutral at BTIG for what the analyst says is too much uncertainty. Although PayPal has seen strong growth from its Braintree unit, it offers lower margins than its standard payments business, which makes a return to profits and revenue growth a multi-year initiative that won't come to fruition in 2024 alone. This is actually PayPal's second downgrade this week, and the stock, nevertheless, up by 2.3%. And finally, Columbia Sportswear taking a hit at UBS with a downgrade to sell from neutral. The analyst says persistent top-line challenges likely lead to an earnings miss, adding that U.S. softline retailers can expect this year to be volatile. You can see the stock currently down 2% at 75.37, and those are some of our top calls. Now, speaking of athletic retail, investors are buzzing about Peloton's new partnership with TikTok, which will be the first outside of its own channel. It'll launch a fitness hub featuring live classes, original content, and celebrity appearances. For more on how this could all play out for Peloton, we're joined now by Shweta Kajuria. She is a research analyst at Evercore ISI, and she rates Peloton in line. Shweta, from where you sit, obviously this is great for brand recognition, but how will this partnership work?
First of all, thanks for having me. From my understanding, this is more of a marketing push on Peloton's side. So essentially think of it as Peloton spending on content and marketing to be on TikTok, but arguably a bit subsidized spend because TikTok is partially helping out on the content cost. So it's a subsidized marketing spend, which to Peloton's credit is a huge win for the company in terms of their choice of brand marketing spend, because of the audience that TikTok offers of 1 billion plus. I'll stop there.
Right. Will it lead to any meaningful revenue, though?
In the near term, we don't expect to. I view this as a marketing spend that takes some time to play out in the on the P&L, on the revenue front. And it's just similar to trying Peloton's effort to change the brand perception. Becoming a little bit more positive, addressing the Gen Z cohort, and all this takes time to play out. The ideal goal is that the brand perception continues to improve. The TikTok audience then goes to Peloton's app, starts engaging arguably for free, and then eventually converts to becoming a subscriber. This is a long cycle. It's not performance marketing where you see an immediate click to download.
Listen, most of the analysts that have a rating on Peloton right now are at a hold. At what point do you turn around your recommendation? What would you need to see a real recovery in a stock after you've seen such steep sell-offs, 23%, 77% in the last couple of years?
Yeah, I mean, that's a great question. And there are a few things. First of all, if we just stick with the valuation, Peloton on its subscription business itself, it's trading at around 2.5 to 3 times its subscription gross profit. That's not demanding. I get that. So it could be a takeout candidate. This speculation was going on a couple years ago. It's back now, given where the stock is.
Is that really the only reason to hold on to the stock at this point, hoping it gets taken over?
For market-driven investors, maybe it is. But I'm going to refrain myself from commenting on speculation. So just on fundamentals of the business, what would turn us positive to being buyers of the stock are a few things. One is that Peloton is in a situation where they are trying to balance positive free cash flow and profitability and top line. That's a very difficult balance if you believe that they've already seen a meaningful pull forward of demand. So exiting fiscal year 2024, they expect break-even free cash flow. Now, what happens beyond that is, are they going to be able to be sustainably free cash flow producing business while also being able to show top line growth? Jury's out on that one. We are not very sure of that. This could be a low single digit top line grower if we believe that most of the people who have the fitness device or a product are already out there in the market. And so that's the number one thing that we'll be looking for is the market opportunity bigger than what we currently think it is?
Got it. Shweta, really appreciate it. Shweta Kajuria over at Evercore ISI. And Shanali, I was just thinking about how over the holiday season, I actually saw some Peloton commercials airing on television, and it's been a while. They definitely came out during the pandemic and after, in the aftermath of the pandemic, but they were starting to really, push the idea of the brand to everyone again.
And you have to wonder, you have to sell new Pelotons to make that money.
Have you checked it out on Facebook Marketplace? A lot of used Pelotons available there.
Yeah, exactly. There was a lot of that going around on my holiday break.
All right. Coming up, we're going to turn back to the jobs report from today and discuss the state of the U.S. economy with Daniel Hornung. He is Deputy Director of the National Economic Council at the White House. This is The Close on Bloomberg. It is Jobs Day, so we want to go over to Washington now and get the view from the Biden administration on the latest jobs numbers. Joining us from the White House is Daniel Hornung. He is Deputy Director of the National Economic Council. Daniel, good to speak with you. I'm wondering how you are sifting the data for a clean read of the U.S. labor market, because on the one hand, the Labor Department report shows blowout payrolls, 216,000 jobs added, the unemployment rate staying at 3.7%, yet you have the ISM survey data showing a contraction in service jobs, which is the bulk of the U.S. job market. What's noise to you? What's signal?
Well, look, with today's job report, we now have employment data for the full year of 2023. And we can say that over that year, the economy created 2.7 million jobs. Other than this year and last year, you have to go back to 1966 for a year where the unemployment rate has been below 4%, and we've seen this many jobs created. The consensus forecast a year ago was that it would take a spike in unemployment to get the kind of disinflation we've seen, and instead we see continued strong and steady job growth. So we're very encouraged by today's report. We think it's consistent with the president's goal of really continuing to bring inflation down, lower costs for American families, and keep a strong and steady job market.
Overall, why do you think the economy and the job market are holding up better than expected? Given how much interest rates have increased in such a short amount of time, what do you chalk it up to? Is it productivity? Is it the healthy household balance sheet? What is it?
Well, look, over the last 9 months or so now, we've seen real income growth for consumers. So workers' wages are growing faster than prices. That's on top of the fact that wealth is now higher than it was before the pandemic after accounting for inflation. So we're seeing workers with strong wage growth, workers with strong balance sheets, and that's really making a real difference in being able to power this economy forward as businesses continue to hire.
But wages are also a key part of the inflation story. And if you look at wages and if you look at also the volatility in oil prices here, how concerned are you of a reacceleration in certain inflationary forces, given the pain that many Americans have felt the last couple of years?
Look, inflation now over the last 6 months is running at that pre-pandemic level of 2%. We obviously need to be mindful of all risks on the horizon, but it's extraordinary progress that we've been able to see this kind of progress on inflation at the same time that we've kept a resilient job market. So we're encouraged by what we're seeing in the data.
But what about oil prices in particular? There are some things that are in the Federal Reserve's control, and then there are some things that are really at the whim of geopolitics here. How volatile can oil prices in particular get through the next year?
Look, one of the things we've seen in energy markets, obviously after that significant spike following Putin's invasion of Ukraine, gas prices have come down from their peak of the $5 range to around $3.10, in some parts of the country below $3 a gallon. That's provided real relief for consumers. We're obviously continually monitoring geopolitical risks and anything that could make a difference on that front. But we're encouraged by what we've seen in energy markets. And as we've gone through the holidays and heading into 2024, that relief at the pump has provided real relief to consumers.
It's relief, to be sure, but not necessarily relief from given how much oil prices had gone up and other costs for that matter. Daniel, if the economy is holding up well and the labor market does remain fairly resilient, you talked about wage increases being a source of that support. Why do consumers and therefore voters seemingly feel the opposite? They express a lot of dissatisfaction with the economy.
Look, there's no doubt it's been a difficult 2 years, difficult 3 years, 4 years for the American people coming out of the pandemic. Disruptions to supply chains, disruptions to global energy markets, and frustration with high prices. The president understands that. One of the things that we've long said, though, is that as wages grow faster than prices for a sustained period, as we've now seen, that might start to show up in the consumer sentiment data. What we saw in December and the jump in both the Michigan survey and the Conference Board survey could be an initial indicator that that kind of strong real wage growth, real income growth is flowing through to the way consumers and the American people are thinking about the economy. But I will say, the president is going to be very clear in the year ahead in making the case that he is fighting to lower costs for American families, doing everything in his power to bring down costs, while unfortunately congressional Republicans appear more focused on tax cuts for the wealthiest Americans and the largest corporations.
Interesting you should bring that up. There's always a lot of comparisons between now and what happened in the 70s when inflation was really raging. Nate Cohn of the New York Times says a better comparison is looking at today versus 1952. Harry Truman, the only other president besides President Biden to oversee an economy with more than 7% inflation and sub 4% unemployment and rising GDP. Voters were not too happy back then, and in the end, we saw Truman's approval rating tank. Truman at the time blamed the do-nothing Congress for not doing much more. Do you see parallels there?
Look, I'll talk about this president. He's passed legislation to lower prescription drug costs, energy costs, healthcare costs. Republicans in Congress want to repeal that legislation. He's pushing for tax fairness and including tax relief to families with children. Republicans in Congress have been more focused on tax cuts for the wealthiest Americans and largest corporations that would explode deficits. So there's a big contrast in terms of what this president is fighting for on the economy and what congressional Republicans seem to be fighting for.
Listen, we've been talking a lot about how the American economy feels in relation to inflation, but there are some things that investors, Americans are very concerned about in terms of the health of the consumer moving forward. Credit card debt is at a record. Student loan payments have resumed. How much more can the consumer feel strapped under the burden of more debt in the next couple of months?
Well, I make a couple points there. First, that real income growth is really supporting consumer spending. And, if you look at things like debt payments as a percent of income, we've actually seen debt service payments at a relatively low level. So we have seen some normalization of things like credit card debt and credit card delinquencies. But we continue to see a strong consumer really powered forward by that strong labor market.
given what we saw around this time last year, do you worry that there could be another turn in the economy? You think about the regional banking failures that we saw last March that could start to set that soundness off course.
Look, we are continually monitoring all risks to the economy and to the financial sector. There's no doubt about that. But, a year ago, I think many people were saying that we were on the verge of a recession, that it would take a large uptick in unemployment to get inflation down. We've seen a remarkably resilient 2023, and I think the economy is well positioned for continued resilience into 2024.
Daniel Hornung, Deputy Director of the National Economic Council, thank you for joining us today. It was an important jobs day and a lot of very important economic data in the next week. Scar, that was a very well-rounded interview heading into the CPI data release next week as well. I know a lot of investors are already looking past today's jobs report.
As always.
Because, we do have a strong jobs market. So really, it's that inflation story that's plaguing most of the economy still today.
Right. And even though the headline numbers looked really robust, as Tom Porcelli was telling us, if you look a little bit beneath the details, there are signs that the job market is slowing, which is pretty much consistent with what you'd expect given how many interest rate increases we've had. It's just taking a long time to play out.
Yeah, and the wage increases are interesting. You're hearing the White House, the Biden administration's National Economic Council, be proud of those wage gains relative to inflation.
All right, we've got much more coming up on the close. We've got just over an hour to go before the closing bell, and it does look like stocks are actually, they've turned around a little bit here with the S&P now negative, just in the red as we head to the close. It's just about 3 p.m. in New York. This is the countdown to the close. Let's get a view from the top. I'm Scarlet Fu.
And I'm Sonali Basak.
And if you were hoping for stocks to end their losing streak in 2024, it doesn't look like it's going to happen right now because we're looking at the major indexes in the red, not by very much, but in the red, despite a better than expected jobs report. We were going to get the first gain of the year, but then you had the ISM report, Sonali, that kind of gave everyone a head fake.
Yeah, there was certainly a head fake in the ISM data, and it's interesting because those rate cut expectations in the Fed swap stayed roughly the same. But you are seeing the stock market once again reacting nonetheless to that conflicting economic data, as well as some single name stories here if we want to take a look at some of those movers.
Yeah, in just a moment, I want to point out, though, the 10-year yield right now up 4 basis points. That doesn't really tell the whole story, right? Because at one point it moved up quite a bit, and it's just remarkable how much gyration there was in the span of 2 hours and 10 minutes or so. You were talking about how much investors are pricing in rate cuts. Yeah, right now it's more than 5 times of rate cuts this year. Less dovish than earlier this week and last week when they were pricing in more than 6 cuts, but that number has really fluctuated just today alone.
Yeah, it's interesting. It's fluctuated this week alone, and that round trip we have seen in yields, we have seen yields drift higher, and the fact that it's above 4% today after starting this week at below 390, we have still seen well over a 13 basis point move, or almost a 15, 16 basis point move over the course of a week, let alone that intraday move that we've seen.
Exactly. All right, you were talking about some individual movers.
Oh yes, we were. We're watching Peloton as one of them.
What, as a takeout candidate?
Yes, that big takeout candidate. M&A is back. I don't know if you've heard, Scarlett. It is rising more than 7% on the day today. Remember, they have that deal with TikTok that investors have been getting excited about. I also want to point to another tech stock, if you will. Let's talk about Apple for a second here, because you have the New York Times reporting on a potential Justice Department investigation moving into earlier stages here. It is now down about 0.8%. And remember, Apple has had a bit of a tough week here because you do have investors also concerned about the economic data when it comes to Apple. And as we talk about M&A as well, I also want to bring up Synopsys here because you are seeing movement in that stock as well. You're seeing it down more than 2% on the day. And that is after a deal that has been announced. It's said to enter advanced talks for Ansys, another software provider, for about $35 billion. And remember, this is the year for M&A coming back. If investors don't reward it, do you still keep seeing more of it?
Yeah, absolutely. I feel like that particular tie-up has been discussed for quite a bit. And there's so many players in the enterprise software space that consolidation is necessary. And it's just a matter of coming up with the right combination, and of course, the right pricing too, while the window for lower rates is open.
Yeah, the window for lower rates is open. That means the financing could be there. But is the regulatory environment there.
Yeah.
And that is something that the bankers have to figure out quickly.
Or maybe they want to wait until
deals.
perhaps after the election. You never know what could happen then.
Because there's no regulation in the Republican administration, right?
All right, we are less than 1 hour away from the closing bell. Cross-platform coverage of the day's top stories starts right now as we join our radio colleagues. This is The Close.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Scarlet Fu and Sonali Basak here. We're joined by our colleagues Carol Masser and Tim Stenovic. And in doing so, welcome to our full Bloomberg audience across television, radio, YouTube, and those streaming on Originals via YouTube, via our different platforms.
Right?
We're everywhere, absolutely.
Yeah.
Happy Jobs Day to you guys.
Happy Jobs Day. And having said that, we've got a really topical story because there might be less jobs for truck drivers. A really fascinating story by our Thomas Black on the Bloomberg Terminal. And it talks about how these driverless trucks are coming on maybe some highways in Texas next year. Basically, we're talking about you've had these driverless trucks, but they've always had a co-pilot. Well, maybe those co-pilots are going away. There's a couple of startups, Aurora Innovation, Kodiak Robotics, and Gatik, I think AI, I hope I'm saying it correctly. But they've got all these sensors. They're ready to go. So bring it on, Tim.
Yeah, they use cameras, they use radar, they use LiDAR to essentially do what driverless cars do. Here's a bit of a difference, though. Okay, they're quite a bit bigger than a driverless car. So you think about the typical driverless car. These trucks are traveling at highway speeds. They weigh as much as 80,000 pounds.
Yeah.
And they're more than 15 times, that's more than 15 times as much as a cruise driverless robotaxi, for example.
No room for error, right?
Zero room for error. Guess who's not happy about this? Truck drivers.
No.
International
Who would
Teamster
be?
Union, right? The Union
But
of
at the same
Teamsters,
time,
not
haven't
happy
the
about
truck
this.
driving companies, the trucking companies had a hard time hiring? They couldn't find enough people.
They have, but, you know, there's like, you know, Mike McKee's going to be joining us in just a minute. He could tell us exactly how many truck drivers there are in the U.S., but there are tens of thousands, so it's a big deal.
Yeah, it's not the only place we're seeing technology really take a hit when it comes to the job market. We were thinking about AI and we were thinking about the writer's strike earlier this year. But, you know, there are positives in the job market when it comes to technology as well. Maybe not with AI. I want to talk about real estate, actually, because, you know, TikTok is actually a great place to get a job for a lot of people. And if you think about it, real estate has been a hot and heavy market, as we know. And you want to hear something that's happening, guys?
Sure.
You are watching Gen Z really look to start to take to the internet, flooding people with tips on how to flip and sell properties. And now they're setting themselves apart. Take one example of a woman who was making $2,500 on a Hollywood set and then made about $100,000 in commissions from selling properties from October because Gen Z now is apparently the hot to be selling real estate.
I guess it depends on what market you're in, right?
Yeah,
if you're in a
exactly.
hot property market, sure, you could do that. But if you're not and you're fighting for listings and you can't get a listing, you could represent buyers, but you won't be able to sell them anything.
I got to say, I've got a relative who's in the mortgage market, and it's been a rough year. I mean, it's been such a slowdown coming off of, you know, the craziness and hectic pace of the pandemic. So for these folks, right, Tim, who maybe haven't seen a down market, it's got to be kind of eye-opening.
Well, I think what's also interesting about this story is just the changing face of a realtor here in the United States. I mean, according to the National Association of Realtors, the typical realtor is above the age of 60 and a woman with a college degree. So, look, this happens when generations start doing new things and when people get new jobs. And the way that young people are getting into this is a different way than, you know, older generations got into it thanks to technology that's available now that wasn't available a few years ago.
You almost said the way that we do it, Tim. I saw that.
Not me.
Nobody on this panel, I've got to say, is Gen Z. I don't believe.
Nope.
I didn't buy a house through TikTok.
Barely a millennial.
Yeah.
I don't have a house.
But I think what's interesting, these conversations we're having, and especially in a year where, once again, artificial intelligence, the next generation, is going to be a big part of probably the investment landscape and just the general landscape overall. So you do wonder, how does this next wave of technology kind of impact our labor force on a day when we've been so focused on it? A week, really.
And how do you buy
feel?
a house if you're in Gen Z or a millennial?
How would you guys feel if you were on the highway and a truck passed you and there was no driver in it.
Oh my God.
Or if
I'd be
you passed a
terrified.
truck, which would be more
I feel
likely because they're
sad
kind
or
of going to go
scared
less than the speed
sometimes on a
limit.
New Jersey highway when there are drivers.
Yeah, the New Jersey Turnpike with the truckers is a little scary,
Well,
I'll say that.
There's some pressure on these startups. Their investors are like, listen, we've been funding you, you've been testing, we're losing money, we want to make money, so let's get it out there. And they've got some big partners, Walmart, Kroger, Tyson Foods, so let's see if they actually hit the highways come
The interesting thing about that whole story, though, it's state by state, right? Like this doesn't
Correct.
happen in California, but it'll happen in Texas.
Yeah, the federal government's like left it up to each state, so there's this patchwork of regulations. So
wide open spaces. Okay. We can do it there. All right, guys, we're going to continue our conversation, wrap up the first trading week of 2024. We'll be back in less than an hour's time. Radio, TV, YouTube, Bloomberg Originals. Join us at 4 p.m. for Beyond the Bell.
All right, let's get back to the markets right now and welcome Gene Tenuzzo. He is Global Head of Fixed Income over at Columbia Threadneedle Investments. Gene, it's so good to see you. And as we wrap up the first trading week of 2024 and I look at yields, at least today, Treasury yields not moving a whole lot where they are right now from yesterday's close. But my goodness, they've moved a lot throughout today's trading day, especially this morning on the heels of different job data. Are we going to get a quieter fixed income market this year than we did last year?
Hi, Scarlett. Happy New Year. I think we will. And I think that's a bit of the story going into 2024. Frankly, if we look at the last year and a half to 2 years, the Fed and inflation have been headwinds for the bond market, and they should be tailwinds in 2024. Interest rates should moderate at lower levels, and we should get lower volatility as well. I think the market is trying to grapple with exactly when the Fed will start those rate cuts and how aggressive they will be to start with. But I think lower volatility is something we should expect this year.
What did you hear from the different Fed speakers over the last couple of weeks when you combine it with the data that we've been getting? How high is the bar to raising rates at this point versus cutting rates?
I think there's an important observation we've made over the last month or so listening to Fed speakers, and that's that the Fed is on on two tracks at the moment when we think about rate cuts. The first is looking at growth. And of course, the Fed will cut if and when there's a demand shock and a risk to growth, but that's not a worry in the near term. The second track is purely about inflation, even in the absence of growth. So it's not about whether or not today's jobs report was strong or not. It's simply looking at inflation and let's look at that last interest rate increase in July. At that point in time, the Fed funds rate was about 1% above the last 12 months core PCE inflation. Since then, we've seen inflation come down, so that real interest rate has actually gone higher by more than an additional percentage point, and they feel uncomfortable with that. So we've heard that from Powell, we've heard that from Waller, and I think that's an important framework that is separate from whether or not the economy is weak or if there's a growth shock. It's that they don't want real interest rates to continue going up passively as inflation gets lower. And I think that's enough for them to get started on interest rate cuts in the first half of this year.
What are the risks to that view of interest rate cuts? Here we have more and more investors starting to highlight the potential for even more hikes, which is a widely different view than we saw at the end of just last year. What would cause the direction of travel to then change now?
I don't think hikes are likely in the cards personally. I think the greater risk, frankly, is that the Fed decides at some stage that the easiest thing to do is to do nothing. And the market certainly has priced in a fairly healthy set of interest rate cuts, 5 or 6 cuts, as you were just showing a moment ago on screen. And, it can be very easy if we are seeing healthy average hourly earnings, if perhaps next week we were to see a slightly higher than expected CPI and those type of prints were to continue, to simply stay pat and to leave interest rates where they are is often the status quo can be a comfortable thing to do for a period of time. And that would disappoint the markets in a pretty big way. I think that's a risk. I don't think it's as likely because I do think the change in trend in inflation is durable, and that's something that will materialize even further throughout the course of this year.
Okay, given that the Fed's bias is probably to sit tight and not do a whole lot, but they may be pushed to actually cut, what is the best approach then when it comes to fixed income holdings? If you're looking to get in or start taking a position, what would you recommend?
Well, the first thing I would say is that reinvestment risk is starting to matter. If we look back at the last year and a half, as interest rates were rising very quickly and the yield curve was inverted, investors got very comfortable that a money market type yield at a low to mid 5% type range was competitive with other fixed income assets, and they were comfortable sitting there. Well, if the Fed's going to take short-term interest rates lower, you get that reinvestment risk in a very real way, and being able to lock in 5 or 5.5 or 6% on investment grade type assets today for the next 3, 4, or 5 years is really going to outperform those short-term instruments. So I think the first thing is stay invested and lock in those higher yields for a longer period of time in investment grade bonds, but also probably don't get too excited about riskier bonds like high yield in this environment, because that risk premium is getting pretty skinny.
Our thanks to Gene Tenuzzo, Global Head of Fixed Income over at Columbia Threadneedle Investments. And of course, we know it's a crazy time for fixed income. Coming up, we're going to get another view of the jobs market from the perspective of private employers. Our guest is Naila Richardson. She's the chief economist at ADP.
Plus, should state health care plans cover the cost of diabetes drugs solely for weight loss? We're going to talk with Dale Folwell. He's a treasurer of North Carolina, the state, on how his state is handling the high cost of these drugs.
And why rookie sensation of the NBA, Victor Wemby, could become the first professional basketball player to earn $1 billion on the court. All that and more coming up. This is The Close on Bloomberg. Let's get back to the jobs market, and today's government report wasn't the only data point to watch this week. Yesterday, ADP came out with its national employment report, and it said private employers added 164,000 jobs in December. It was the fourth straight month of gains, led by a healthy bump in leisure and hospitality hiring. And joining us now is Naila Richardson, chief economist at ADP. Talk us through the numbers. If you think about the strength we're seeing in the labor market, where is the strength the most fragile?
Manufacturing, and Happy New Year. Manufacturing is where we're seeing the weakness, and that is consistent with this being a highly interest rate sensitive sector. I'd contrast that, though, to construction, another highly interest rate sensitive sector, and yet there's been such a resurgence in demand. I know that home ownership is in your future. And as you talked about the next segment, not having a house, but there's so many people who want one, and that demand is strong enough to overcome even higher mortgage rates. Very different from manufacturing, which has been in a virtual recession throughout 2023 and even before. The power is coming from services, and as you know, that bump up in leisure and hospitality not only fueled the industry, it helps a rebound in small businesses, which we track very closely here at ADP.
Well, it begs the question, too, if that was an area that did see strength, and thank you, by the way, I do try to be the everyman over here. If you have more in terms of leisure and hospitality and you have a worry about the U.S. consumer, how strong are you seeing those numbers relative to any kind of struggles they might see into this year?
I think those leisure and hospitality numbers are really what to watch. We saw weakness the last 2 months, and to us, that signaled a fatiguing consumer. And yet, there are some in the industry that are saying that there was record travel over the holiday season, and leisure and hospitality benefited from the fact that people did get up and move and go visit over the holiday season. We also saw some strength in retail, suggesting that the consumer is not quite as fatigued as was commonly thought, but it's notable that retail hiring is stronger than it was last year, but not as strong as it was pre-pandemic. Okay, so there is some drive there, but it's more aligning to a more balanced labor market. I don't think we're seeing strong bursts in hiring like we saw last year.
One area of strength that we saw in today's government jobs report is healthcare. 164,000 private payrolls, but if you strip out healthcare, that would only leave about a 100,000 gain. Why is the healthcare industry so strong when it comes to hiring?
Yeah, that's been a surprise to us as well. And we've noted that healthcare strength over the last few months. It's really become a resurgence since healthcare took such a hit during the pandemic. And I really think it points to something not cyclical at all. This is not an interest rate sensitive sector. It points to the demographic future, the fact that we are an aging country and nursing, healthcare workers, the need for them is far outstripping supply. And what you're seeing there is the future needs of a country that is aging and needing more healthcare and more healthcare workers.
Yeah, demographic changes are such a long-term trend that it's hard sometimes when you can actually chalk things up to long-term events like demographic changes. Talk a little bit about wages as well, because this is an industry, of course, that needed workers and for so long had a difficult time attracting enough qualified and credentialed workers to its workforce. What kind of wages is healthcare and therefore the private industries at large paying?
Well, they're actually slowing their pay growth. And we've noted this change since September 2022. Remember that ADP is a payroll company. So we're looking at actual paycheck data, not survey data like you saw in the BLS report. And we're able to match this data for 10 million workers in the United States on an individual basis for a year or more. And what we've seen is a steady decline over the course of 2023, both for people who stayed in the same job and people who switched jobs. And that to us leads us to believe that this wage price spiral, something that has been keeping economists up at night since the inflation battle started, is all but disappeared. Wage growth is starting to decline. I know we saw a bump up in the BLS report today, but I think the overall trend is consistent with an inflation metric that is consistently moving down.
How do you think about the impacts of interest rates on a lagged basis? You had started to talk about the more interest rate sensitive sectors already feeling the pain, but how do you expect kind of these elevated rates to keep feeding through payrolls?
Well, right now, they haven't been a big blocker to hiring in the service sector. I do have concerns about small business hiring going forward, businesses who are trying to grow, and the small business loans that'll get there and the rates that they will have to pay. I also have some concerns on the consumer side, because as we know, that consumer spending is more and more being supported by credit card debt and at, two-decade highs in terms of interest rates. So bringing that all together, the question is, will the consumer keep spending, especially in the service industries like leisure and hospitality that has been driving the jobs market?
So moving forward, Neela, as we look into the spring and the summer eventually, what sectors would you be paying attention to when it comes to hiring and job wage growth?
I would still look at healthcare, but another trend that I think we have to say goodbye to, unfortunately, is that leisure and hospitality will drive the labor market. That has been true for the past 2 years. I don't think we can rely on that anymore, and there's no clear front runner over who takes leisure and hospitality's place. Maybe when those hikes eventually materialize, we'll get some resurgence in manufacturing. But I think that means that overall the labor market gains will be slower in 2024 than we've gotten used to even in the second half of 2023.
All right, got it. Neela, really appreciate your joining us. Neela Richardson is chief economist over at ADP, which of course published its employment numbers as well today. Let's go now to President Biden. He's speaking on the stump at Valley Forge ahead of the January 6th anniversary. Let's listen in.
Thank you, thank you, thank you. Thank you. Well, thank you. Thank you. Thank you. Please. Thank you. Please. Thank you very, very much. Today, the topic of my speech today is deadly serious, and I think it needs to be made at the outset of this campaign. In the winter of 1777, it was harsh and cold as the Continental Army marched to Valley Forge. General George Washington knew he faced the most daunting of tasks: to fight and win a war against the most powerful empire existed in the world at the time. His mission was clear: liberty, not conquest; freedom, not domination; national independence, not individual glory. America made a vow: never again would we bow down to a king. Months ahead would be incredibly difficult. But General Washington knew something in his bones, something about the spirit of the troops he was leading, something about the soul of the nation he was struggling to be born. In his general order, he predicted, and I quote, "With one heart and one mind, with fortitude and with patience, they would overcome every difficulty," the troops he was leading. And they did. They did. This army that lacked blankets and food, clothes and shoes, this army whose march left bloody bare footprints in the snow, this ragtag army made up of ordinary people, their mission, George Washington declared, was nothing less than a sacred cause. That was the phrase he used, a sacred cause. Freedom, liberty, democracy, American democracy. I just visited the grounds of Valley Forge. I've been there a number of times from the time I was a Boy Scout years ago. You know, it's the very site that I think every American should visit, because it tells the story of the pain and the suffering and the true patriotism it took to make America. Today, we gather in a new year, some 246 years later, just one day before January 6th. A date forever shared in our memory because it was on that day that we nearly lost America, lost it all. Today, we're here to answer the most important of questions. Is democracy still America's sacred cause? I mean it. This is not rhetorical, academic, or hypothetical. Whether democracy is still America's sacred cause is the most urgent question of our time. And it's what the 2024 election is all about. The choice is clear. Donald Trump's campaign is about him, not America, not you. Donald Trump's campaign is obsessed with the past, not the future. He's willing to sacrifice our democracy, put himself in power. Our campaign is different. For me and Kamala, our campaign is about America. It's about you. It's about every age and background that occupy this country. It's about the future we're going to continue to build together. And our campaign is about preserving and strengthening our American democracy. 3 years ago tomorrow, we saw with our own eyes the violent mob storm the United States Capitol. It was almost in disbelief as you first turned on the television. For the first time in our history, insurrectionists had come to stop the peaceful transfer of power in America. First time. Smashing windows, shattering doors, attacking the police. Outside, gallows were erected as the MAGA crowd chanted, "Hang Mike Pence." Inside, they hunted for Speaker Pelosi. The House was chanting as they marched through and smashed windows, "Where's Nancy?" Over 140 police officers were injured. Jill and I attended the funeral of police officers who died as a result of the events of that day. Because of Donald Trump's lies, they died because these lies brought a mob to Washington. He promised it would be wild, and it was. He told the crowd to fight like hell, and all hell was unleashed. He promised he would right them. Everything they did, he would be side by side with them. Then, as usual, he left the dirty work to others. He retreated to the White House. As America was attacked from within, Donald Trump watched on TV in a private small dining room off the Oval Office. The entire nation watched in horror. The whole world watched in disbelief. And Trump did nothing. Members of his staff, members of his family, Republican leaders who were under attack at that very moment pled with him. Act. Call off the mob. Imagine had he gone out and said, stop. And still, Trump did nothing. It was among the worst derelictions of duty by a president in American history. An attempt to overturn a free and fair election by force and violence. A record 81 million people voted for my candidacy and to end his presidency. Trump lost the popular vote by 7 million. Trump's claims about the 2020 election never could stand up in court. Trump lost 60 court cases, 60. Trump lost the Republican-controlled states. Trump lost before a Trump-appointed judge and then judges. And Trump lost before the United States Supreme Court. All of it, he lost. Trump lost recount after recount after recount and state after state. But in desperation and weakness, Trump and his MAGA followers went after.
All right, you're listening to President Joe Biden speaking in Valley Forge, Pennsylvania at his first campaign event. It is 2024 after all, preparing for the elections. He's casting the election as one in which American democracy is at stake. And of course, he's taking the opportunity, given that it is approaching the third anniversary of the January 6th attack on the U.S. Capitol when former President Trump supporters sought to block certification of the 2020 election that brought Joe Biden to the presidency. If you want to continue listening to the president's remarks, you can go to the terminal and type live go. In the meantime, we want to get back to one of the big stories of 2023, which has been the popularity of weight loss drugs. They're actually diabetes drugs, but of course, the side effect is that they do help you lose weight. And as these drugs reach new heights, the popularity of it, states and local health plans really find themselves sifting through some eye-popping bills, pricing in more than $1,000 a month. And now officials are starting to sound the alarm bells. Bloomberg's Simone Foxman has been writing about this, and she's here with us with more. Also joining us right now is North Carolina State Treasurer Dale Folwell. But I want to go to Simone first for more on this. Simone, can you just set this up a little bit and tell us what's going on here? What's the quick overview?
Well, we knew that these drugs are expensive, and essentially once you're on what are called GLP-1s like Ozempic, Mounjaro, Wegovy, a formulation specifically tailored to weight loss, you essentially have to take them forever. However, doctors think they're transformative. So we wanted to understand just what the burden was on government and therefore the taxpayer. And what we found out is it's already enormous. When you think of Medicaid, for example, the government, Medicaid reimbursed $7.9 billion worth of pre-rebates, 8.5% of its overall prescription budget for these drugs for both diabetes and weight loss in 2022. This year it's likely higher, and various state governments have already struggled to meet sort of the rising cost of this, something I know Dale can speak to.
All right, so let's bring Dale into the conversation. Dale Folwell, the North Carolina State Treasurer. Dale, how is the state currently covering the costs of Ozempic, Wegovy, and this class of GLP-1 drugs? And how much of a burden is it for your state healthcare plan?
Our state health plan will be under siege because of the cost of this one drug. I have two examples with me. We're not questioning at the state of North Carolina how effective these drugs are, or whether people are getting off or getting off of on or off of them. What we're desiring in North Carolina is to pay the same price for this as they pay in Denmark for this. This is where the home country of Novo Nordisk is. If they will charge those in North Carolina who teach, who protect, and otherwise serve the same price that they charge the people in their home country, we can budget and get through this. But as Simone has already reported, in many instances, the cost of this drug is 4, 5, 6, or 7 times larger than what people in Denmark pay. So that's what we're after in order to keep our state health plan on behalf of those that teach, protect, and serve solvent.
Treasurer Falwell, there's this thinking, I guess, that weight loss or obesity is sort of a discipline. It's a personal problem. It's not a medical problem. And someone at the recent board meeting that you were at essentially said, we wouldn't cut cancer drugs, coverage of cancer drugs just because they're expensive. How did that play into your thinking when making the proposal to limit coverage?
Well, our thinking is not emotional, it's not political, it's actually mathematical. The cost of this one drug, my wife always says to try to put things in context. This drug is being consumed by about 22,000 people right now on the state health plan. The General Assembly just paid out a 4% bonus to nearly 240,000 people. That 4% bonus is the exact same cost as $170 million for this one drug. So what we're trying to do is to figure out what's right, get it right, and keep it right. And we are not opposed to talking to Novo Nordisk about how they will lower this cost. We are not opposed to talk to our pharmacy benefit manager about how to lower this cost. We're not opposed to learning about best practices that other states may be incorporating, but all the states, all the private and all the public health plans, including the federal government, are going to be under siege because of the cost of this one drug.
Now, one thing that came up was that Novo Nordisk, you say, threatened to cut the rebates that the state gets, amounting to some $600 plus, if you guys limited who can receive these drugs for weight loss. Has that transpired now that that January 1 date has passed and you've placed a moratorium on people getting these drugs for weight loss for the first time?
We're not aware that these rebates have been cut, but these rebates are what we use in our pharmacy benefit management contract to keep our family premiums frozen for the last 7 years, even though the cost of prescription drugs and health care are skyrocketing. So these rebates are very important, but it's also important for your viewers to know that we're not going to be bullied about this topic. It's a very important topic when one drug could put the security of the state health plan, the solvency of the state health plan into question.
Now, Novo Nordisk might be a Danish company, but it does have 3 plants in North Carolina to make obesity and diabetes drugs. Is there any concern that that could change?
Well, let's start out by thanking Novo Nordisk for being an employer and a taxpayer in our state. But let's also recognize that one of my responsibilities as the keeper of the public purse and as the state treasurer is to approve water treatment plants and things of that nature. And over the last year, we have approved over $100 million for a water treatment plan for this company. So we understand the importance of this company as an employer and taxpayer. We continue to work with them so that their infrastructure needs can be met for the manufacture of this drug or any other drug. But at the end of the day, what we desire is to pay the same price for this drug as the people in their home country pay. If they will lower this price and charge us what they're charging people in their home country, as the state treasurer of North Carolina, I think we can budget our way through this.
All right, Dale Falwell, really appreciate your joining us. Dale, of course, is the North Carolina state treasurer, talking about the cost of course, paying for these treatments, these obesity treatments, these diabetes treatments. Bloomberg's Simone Foxman with this Bloomberg News story as well. Check it out on the Bloomberg terminal and at Bloomberg.com. Coming up, we've got the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg. It's time now for the top three. Every day at this time, we take a deep dive into the people at the center of the day's top stories. Let's start with Howard Davies, the chairman of NatWest in the UK. After his remarks on the housing market, he told the BBC, Rushanali, it's not, quote, that difficult for people to get a mortgage at this moment. This is the former deputy governor of the BOE and also previously the UK's top financial regulator, making some out-of-touch remarks.
Yeah, of course, it has been very difficult indeed for many people to buy a home, both in Europe and the United States. We should say in a subsequent statement, he said he didn't intend to underplay the serious challenges. There's another person I'm watching. It's Gautam Adani. Remember, there was that Hindenburg research report last year, but now after a roller coaster ride in his wealth rankings last year, he's back to being Asia's richest person. Just days after India's top court said there were no new probes that were needed into Hindenburg Research's bombshell allegations against the tycoon's conglomerate. Remember, he regains his title against Mukesh Ambani in the title of the richest man in Asia.
Yeah, but they, of course, spent a lot of time wooing back investors, lenders, repaying debt, and, of course, addressing regulatory concerns. And even though he's back on top, he's still not quite where he was before the Hindenburg allegations came out. Third person that we're watching today, Victor Wembanyama. He is the 20-year-old French-born NBA rookie, currently on a path to become the first pro basketball player to earn $1 billion on the court. So let's bring in Bloomberg sports business reporter Randall Williams for more. He's 20 years old and he's going to make $1 billion by when?
By 2036 or 2037. And he'll be 33 by then, but yeah, $1 billion.
What does this mean in terms of how he's able to really negotiate for himself against the NBA's contract limits?
Well, so in 4 or 5 years, he'll be eligible for a rookie extension. And all he'll have to do that is basically not get in trouble and be healthy. And we've seen players get injured before, but a lot of times when you're a supreme talent, you're guaranteed that first extension, which will probably exceed $300 million. After that will be the Supermax, and then another Supermax after that, where if he qualifies, he becomes an MVP, he's on an all-NBA roster or something along those lines, he can reach those premium contracts.
Okay, I'm just looking at these pictures, and they're pretty remarkable. I mean, he's a basketball player, so obviously he's tall, but he is kind of in a different category
for
unto
sure.
himself.
For sure, yeah. I stood next to him. I'm 5'10", and I mean, I stood next to Kevin Durant before as well, and Kevin Durant's tall, but when you have someone as tall as Victor Wembanyama that makes Kevin Durant look small, it's ridiculous.
How tall is he again?
He's 7'4". Kevin Durant is, I'd say, 7 foot. They say 6'11". I mean, look at me. Look at me right there. That's ridiculous.
That's bananas.
That is something to look at. I'm interviewing Shaq at the end of the month, too, and I'm really afraid that I won't be able to speak to him. Well, you know, speaking of League of His Own, what even compares to a pay package like this?
You could compare LeBron, you could compare Michael Jordan, you could compare Shohei Ohtani, for example. Shohei Ohtani has a $700 million deal recently, but a lot of times athletes are making their money from off the court. They get these big contracts that get them close to maybe $500 million if they're lucky. But a lot of times they have to go and do business, whether that be endorsements, whether that be investments. And so for him, as long as he stays healthy and he in some ways lives up to the hype of what everyone's saying, this phenom, this 7'4" guy that we've never seen, he can get that $1 billion.
Okay, stays healthy. You said that a lot. There's a lot of buzz around him. And of course, this summer, Paris is hosting the Olympics, and he is going to be the prime player everyone's watching on Team France when it comes to basketball and the Olympics. So his moment is coming here.
For sure. I think that there are some NBA fans out there who haven't seen him play, but everyone's going to be watching the Olympics this summer because you're going to have LeBron, KD, Steph, and so many other athletes on this star-studded Team USA roster. But right now we're in a flux of international stars. The last 5 MVPs in the NBA have all been international stars, and Wemby could very well be the next one. So the Paris Olympics could be his coming out party, but we'll find out during the summer.
Is that what his friends call him, Wemby?
Everyone calls him Wemby. I mean, it's a lot easier than Wembanyama, so.
We have a lot to learn.
All right. Randall Williams, thank you so much. And of course, this is the subject of today's big take. Victor Wembanyama, he will soon be the first $1 billion NBA player to make all his money, his first billion on the court. All right, we've got a lot more coming up, Sonali. We're counting you down to the closing bell. Ellen Hazen of FL Putnam, she's the chief market strategist, is on deck. And of course, we're looking at a market right now that has been fluctuating. It does look like we might be able to end the day if we stay right here with a gain.
But the week is in the red. Stick with us, though. This is Bloomberg.
This is the Countdown to the Close. I'm Scarlet Fu alongside Shonali Bassick. And as we wrap up the first trading week of 2024, December's risk on has kind of turned into risk question mark in these early days of January 2024. You can see the S&P 500 clinging on to a gain right now. If it closes at these levels, this would be the first advance of 2024. And the move higher in yields, the 10-year currently up by 5 basis points, doesn't really show just how much movement there was between 8:30 a.m. and about 10:40 a.m., where things were just kind of all over the place.
Still incredible to watch that 10-year yield float fast back up 4%, now 404, almost 405. The S&P 500 ending on its first week of losses in 9 weeks. And we're going to talk more about this market with Ellen Hazen. She's the chief market strategist over at FL Putnam. Sorry, Ellen. What do you make of this negative sentiment that we've broadly seen this week? Does that continue into January, or is there something that can turn this tide around?
Well, it's a good question. I think that what we saw in November and December was a very rapid acceleration in markets, every kind of market, equities, small caps, bonds, everything. And the market successfully and accurately sniffed out the Powell pivot, which happened in the middle of December. But the markets ran so far, so fast, that it's not surprising at all that they're exhaling a little bit. They were overbought from a technical perspective, and that's true whether you look at equities or fixed income. So as we look forward toward 2024, we think the economy is going to be fine. We think it's plausible, I won't say it's guaranteed, but it's plausible that the soft landing has been achieved. And if that's the case, then we're going to get a high single-digit return in equities. It may be a very normal year in terms of returns going forward. But in the short term, we are going to see some volatility just due to the exhale from the overbought conditions.
What are the relationships between yields and stocks at this point? Because you do have this expectation here that a market can see more rate cuts moving into this year, but you see the 2-year floating higher by more than 10 basis points on the week. You see the 10-year above 4%. And so at what point do you see these rate hikes not only priced in, but potentially oversold?
It's hard to say, right? Because sometimes bonds and stocks are positively correlated and sometimes they're negatively correlated, and it depends on the time frame that you're looking at. But in general, higher rates are negative for stocks. Certainly if they go sharply higher, they're negative for stocks. But if they drift higher, that's actually okay. And we actually think that it's healthy for the U.S. to have positive real rates, which has been the case for several months now, but hadn't been the case for years before that. So as rates exhaled a little bit and you saw rates come down a little bit and now they're trending back up again just a tiny bit, it will affect those long duration stocks more than anything else. But I think it's okay to have slightly higher rates and you can still have a decent stock market as long as rates don't spike sharply.
Right, and that's always been the case, right? I mean, markets can absorb and digest anything. It's the sudden movements that they struggle with. Let's talk a little bit about what a normal market would look like if you were to focus on the fundamentals and look for individual names. There's one name that you do like, and it's Apollo Capital within the alternative investment space. What's the argument for why Apollo is slated to do better?
Apollo has been taking market share very rapidly in the alternative investment space. Not only in private credit, which has been the market's darling over recent months, but across the board. And you can see that company is very inexpensive. It's trading at about 15 times earnings. They have decent return on invested capital. They're growing at high single, low double digits going forward. So given that we believe that the march toward alternatives is going to continue for high net worth individuals, for institutions, for foundations and endowments, the whole space should do fairly well going forward. And Apollo has been taking market share, and it's just a cheap stock.
Okay, got it. I'm also looking at the best performing stocks so far this year, and I know we're talking about a pretty short time period here, 4 days worth. Nevertheless, telecom names top the list here, gaining 4.6%. And you do like T-Mobile, which is the smallest of the three mobile operators, the carriers. Why is that?
T-Mobile has been taking market share, just like Apollo, hand over fist for the last several years from Verizon and AT&T. They bought up spectrum and got more spectrum with the Sprint deal, and they have been growing subs faster than anyone else. And most importantly, they just initiated a dividend in the most recent quarter. They have very strong free cash flow returns, and it's a pretty cheap stock too. So as I look at a growing dividend, a company that's taking market share and yet is still in a very stable industry, that looks like a good bet to us.
All right, we do want to jump in here with some breaking news. According to our reporting, the SEC commission vote on exchange-traded funds related to Bitcoin are expected next week. This was always the case. The Bitcoin ETF applicants have cleared a key hurdle on the path to getting the SEC sign-off. So once again, we're looking at January 10th as the day when several issuers could get their spot Bitcoin ETFs approved. Ellen, I know that you're not necessarily investing in Bitcoin, but at the moment, is this something that you would consider adding to your portfolio? How do you see it affecting sentiment?
Well, I think they've been trying to get ETFs approved for a long time. In general, I think Bitcoin is difficult to invest in because it's very difficult to value using traditional methods. You can't use a discounted cash flow. You can't look at coupons or payments or interest or anything like that. And so it really becomes almost like a currency, and it becomes currency analysis. So I don't think it's appropriate for a lot of the investors that I deal with. But I do think that if the SEC approves it, it will be obviously a sign of approval that may make it more relevant and more appropriate and more acceptable for many investors out there. So I would expect it to spike if that does happen.
Well, what about, I mean, you're going from a currency here or even a commodity to an equity, Ellen. I mean, does it make it more acceptable to invest in if it's an ETF just like any other ETF is?
Technically, it's an equity wrapper, but it's still not an equity, right? It's not as though you are laying claim to future cash flows of a company of which you own shares. It's just an equity-like wrapper for something which is fundamentally a currency.
Yeah, when it comes down to when you're doing the analysis, I get what you're saying, but the equity wrapper makes it that much more accessible to so many investors, which is why those issuers are pushing for it. Ellen, thank you so much. Ellen Hazen is Chief Market Strategist over at FL Putnam. And once again, we just want to reiterate the headlines here, Shonali, as we count you down towards the close. The Bitcoin ETF issuers have cleared a major hurdle on their path to SEC approval. This is expected by January 10th, when a number of those ETFs could be launched.
And the SEC
formally
had told exchanges and issuers seeking to list ETFs that they should submit that final version of that key document as soon as today. So get moving, guys.
All right. Well, they have a couple of hours. They're still business is still open for another hour and 3 minutes at the moment. All right. But in the meantime, let's count you down to the closing bell. We've got full market coverage right here on Bloomberg as we count you down and take you to the bell and beyond. We have the S&P 500 up 0.2%. The Russell 2000, however, still in the red by down 0.3%.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day, end of the trading week. Romaine Bostic is not here today. Scarlet Fu here with you, along with Shonali Bostic. We're counting you down to the closing bell, and here to help us take you beyond
He's here
the bell,
in spirit, I'm
simulcast.
sure. He's here in spirit, or
He's
watching.
always here in spirit. That's a good point. Carol Massar and Tim Stenovic here with us, of course, and welcome to our Bloomberg Television, Bloomberg Radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. Some crucial moments at 8:30 a.m. and then at 10 a.m. And of course, just now, Carol, with the news that the Bitcoin ETF issuers have cleared a major hurdle en route to their SEC approval.
I feel like no surprise when we had Kathy Wood on of ARK Invest. Of course, she is certainly got a filing out there too for spot Bitcoin ETF and has been, someone we've talked to a lot over the last year or so about this. But was it interesting, as she said to us on air, that in terms of the conversations that were going back between her firm and the regulators, like things were getting down to kind of just the nitty gritty details of, like, as I just said to Tim on air, kind of the crossing of the T's and the dotting of the I's. So it does look like the serious issues had been in a large way worked out, and now it was just getting down to the nitty gritty, if you will.
The technicals, right?
Yeah,
the technicals.
All right. So when we look at what's happening in this market today, it felt like we were going to manage to close up. And right now, it might actually happen. The first gain of the new year, 2024, after a pretty dismal start, in which we weren't really sure, Carol and Tim, whether it was, just sell the winners from last year and buy the losers, or whether there's something more fundamental taking place.
That's the question that I have. I mean, we just spoke to Tony Roth over at Wilmington Trust. He said it feels a lot like late October right now. So he would encourage people, if they continue to see a drawdown, potentially 5 to 7%, to jump in. He doesn't think we're going to see another year like we saw last year, but he still thinks it's going to be a positive year for the S&P.
All right, and there you have the closing bells. Look at that. The Dow, S&P, and NASDAQ did close higher, marginally higher. Yeah, the S&P 500 adding 8.5 points to 46.97. The NASDAQ gaining 0.1%, and the Dow trailing behind, gaining about 25 points, or almost 0.1% to 37,466. And the Russell 2000, we should mention, a laggard today, did not get that last lift in the final 2 or 3 minutes of trade, and is closing down 1/3%.
All right. Having said that, just taking a look at what's going on in terms of the S&P, a little bit of a deeper dive, excuse me, but kind of an even split today. 282 names to the upside, guys. 217 to the downside, 4 unchanged.
All right. Taking a quick look at the industry groups, you have telecom stocks in the lead, up by 1 2/3%. Banks will be reporting earnings next week, starting with, of course, J.P. Morgan, Wells Fargo, Citi on Friday, up by 1.2%, and chip makers mounting a bit of a comeback after yesterday's declines, gaining more than 1%. On the downside, household and personal products, food, beverage, and tobacco, some of your consumer staples, and tech hardware still on the down note. That, I believe, is Apple, off by 1/3%.
All right, really interesting. All right, so that's your look at the big broad groups in the trade today. Taking a look at some of the individual gainers, if I may. Moderna on that list. I was going to actually ask you guys a question. Do you want to know what is the #1 gainer in the S&P 500 so far this year? Sorry.
Is it Moderna?
Did you give us a hint already, Carol?
Well, you know what was happening? I knew it before earlier, but I was double checking to make sure nothing had changed. So I'm like, come on, bring it up. Anyway, okay, it is Moderna. It's nice. Up about 12% for the year, up 2.2% here in the trade on this Friday. What's interesting is, I mean, I don't know if you've looked at this chart. It has rallied about 60% since early November, way above its 90-day moving average. It's definitely over bought at this point. But what's interesting is it went through, it's going through some organizational changes. It came out, it's been under a lot of pressure. It had a disappointing forecast early November that took the stock down, but it's really been on a bounce back on expectations of maybe some of the new drugs that might come in its pipeline as it moves away from just being a COVID vaccine. They've been testing and looking, early stage testing, I should say, a vaccine in terms of cancer usage. So anyway, investors have been moving into this name in a big way. And again, top the S&P 500.
No, it's interesting. Sorry to interrupt you. It's just
please.
Interesting that Pfizer has not had that kind of lift, given that it's the other big name in the vaccine space, right?
All has to do with the pipeline, right?
Yeah.
All right, just real quickly, let's talk about NVIDIA. That was your top performing last year in the S&P 500, rallying also today, up another 2.3%. B of A coming out and saying that NVIDIA shares have strong upside potential as the company's position within generated AI supports robust free cash flow generation. They've got a buy rating, a price target of 700. Stock closing at 490 and change today. Truist also raising its price target on the stock to 691 from 674, keeping a buy rating as part of a broader research note on semis and AI. And then I got to talk about Peloton, rallying again on really heavy volume, more than 9 times its 20-day average. Bring it up for you guys. And we're talking about a more than 9% gain, up 25% in the past 2 days. It's all about that partnership with TikTok, hoping to be a bit of a boost for the company and bringing in some new paying members. ISI Evercore views the partnership positively and yet says it's too early to expect any meaningful top-line contribution from the partnership in the near to midterm. But nonetheless, investors are pretty optimistic there.
Yeah, interesting seeing it happen for 2 days in a row, Carol, given that this news came out yesterday. Hey, let's talk decliners real quick. My question is, how many days in a row am I going to talk about Apple as the #1 decliner?
As long as it keeps falling.
That is the right answer.
Nice.
So 5 days in a row lower, 4 days, all 4 trading days this year, down another 0.4% today. Lost about $190 billion in market cap over the last 5 days. Apple stock was bouncing around today. That did end up moving lower after the New York Times came out with a report that said the Justice Department is closer to filing an antitrust case against the company. Also want to talk about Synopsys. The company shot higher today after a report that it was in talks to acquire the advanced engineering software provider Ansys for about $35 billion. Shot lower, I should say, finishing the day down by 1.1%. Synopsys is discussing paying about $400 a share for Ansys in a deal that could be announced as soon as next week. A final agreement has not been reached and talks could still fall through. This according to the people quoted in our Bloomberg story. And then this is a really interesting interesting story. Remy Contro, ADRs, U.S. ADRs of Remy Contro falling. Look at this, close to 12% today. This after China launched an anti-dumping investigation into liquor products from the European Union, adding pressure to a part of the business that has really been affected by slowing growth. This investigation is going to focus on brandy products that come in smaller than 200-liter containers from the EU. It's kind of a niche market.
I love the story.
But it's a really interesting story because we also saw a couple other liqueur brands move lower on the day.
You need some Remy Contro to drink if you're an investor, like after seeing that drop.
I don't know which one is which, to be honest.
You guys are interested in equity markets. I am still looking at yields because I want to talk about the move we saw this week. We have seen them drift higher all week long. And even though you see on the day the 2-year yield relatively flat, you still see it ending at 4.38. And the 10-year yield did drift higher another 4 basis points. That bid getting out of the bond market, a little bit of selling there. That 404 level that we're seeing on that 10-year yield, it jumped as high as 409 earlier on the day. On both of those durations, if you will, you have seen a more than 20 basis point move from peak to trough intraday throughout the course of the week. So you still have a decent amount of bond volatility here. You also saw the 20 and 30-year durations here move 4 basis points higher. So that drift is real, even if you have investors recalibrating what they're thinking in terms of rate cuts this year. That economic data, guys, this week has been quite messy.
Yeah, it's been totally messy, and this really doesn't show the extent of the movement that we had between 8:30 a.m. and about 10:40 a.m., the gyrations and yields and the constant recalibration of what the Fed does next, whether it was from the NFP numbers versus the ISM services employment numbers.
Yeah, our Michael McKenzie, who keeps a watch on the rates market, was just in with Tim and myself, and he said, you know, basically when you see those rates on that 10-year and really kind of all along the curve bump up, especially above that 4% mark, you're bringing investors back into the market, right? Because this is an opportunity for them, especially since the market overall, traders are still expecting a Fed that's going to be pretty aggressive in terms of rate cuts. So there's a little bit of a range, but when you go above 4%, you bring some of the investors back in.
But how aggressive in terms of rate cuts? 6 times this year? Aggressive, or 3 times this year, as Fed members sort of indicated in the most recent summary of economic projections. I think we got data kind of on both sides of this argument today that was, okay, well, you know, in terms of services data that we got, ready to be more bullish on those rate cuts. But in the hotter than expected employment report, some people were less bullish as a result.
We have more data coming up next week. We have, remember, we have an inflation print that we have to look out for, PPI as well. And so we're not out of the woods. And you have to wonder also, what is the year going to end at? At the end of the day, I don't know if I care how many cuts there are. I just want to know where we end the year in terms of absolute levels of interest rates and how the market begins to trade it. Remember, people have lost a lot of money in bond markets over the last 2 years. Is this the year of the bond?
Yeah, I don't know. It's a good question. Having said that, I just want to mention that Richmond Fed President Thomas Barkin, we had a story out just a little while ago, right? He's basically saying no objection to cutting rates if confident of the inflation path, which is why that CPI number next week is a really important one. They are still very, very vigilant when it comes to what's going on in inflation. He's a voting member of the Fed. So I think bottom line, we're going to move from data point to data point. You're right, as investors try to make sense of it and hopefully make some money in this market.
Well, that's a macro perspective, and now on micro perspective, plenty of data points to deal with as earnings season gets started next week. First with the big banks, and then it really gets going.
Yeah, exactly right. Next Friday, we're going to be talking all about the bank earnings. All right, guys, that's a wrap for the first trading week of 2024. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We will see you all on Monday.
All right, coming up, this is news that we just broke in the last 10 minutes. Bitcoin ETF issuers have cleared a major hurdle on their path to SEC approval. We've got more on that next. You can see Bitcoin currently down about 1.6% on the day. This is the close.
Turning to the crypto space, Bloomberg has learned that the SEC has told several exchanges and issuers seeking to list a spot Bitcoin ETF that they should submit a final version of a key document as soon as Friday. that indeed is today. And for more, we are joined by James Seyfarth of Bloomberg Intelligence and Katie Greifeld of Bloomberg News, who is part of the team that broke this story. James, we knew that this could be soon. Now that we know that they are kind of inching past the finish line, how do investors set up for next week, particularly as you're watching Bitcoin actually not having a good day walking into these final moments?
Yeah, so we're looking for those filings that you just spoke about, right? They should drop. I honestly thought they would have come by now, if I'm being completely frank. I kind of thought it would happen because they're coming up on the approval window that we've highlighted, and there's a deadline on January 10th that I'm fairly confident they have to make. So it's going to be a tight turnaround after these issuers submit these 19B4 filings. I'm assuming they're going to come after market close today, and that looks to be basically what Bloomberg News is reporting here. We talked about this a little bit this morning in a note we put out, and this is basically getting us to the 1 yard line. Eric Balchunas, my colleague and boss, actually said this might be the 1 inch line. But yeah, the things are looking very close to being mostly done. We need this to get final approval, which again, we're expecting to come next week after these are submitted today. And then there's one more final step that should just be like just one little thing left to do before these things can ultimately launch. So we could see launches late next week or early the week after Martin Luther King Day.
Okay, so Katie, normally the filing of ETFs is not a big deal. We're not following every single move, and oftentimes issuers need to go back and amend their paperwork. Once this is approved by the SEC, how quickly will it take before we actually see these ETFs trading?
So there's two big hurdles here. The first one, of course, which we reported right now, is that the SEC has told filers and issuers to basically submit their final 19B4s. That is one step. The thing we're still looking out for is the amended S1s. Basically, that still has to be approved. And of course, these 19B4s need to be approved as well. But what we're hearing from our sources is that basically we're getting down to the finish line here, that they really don't have any substantial comments, any substantial feedback yet. So as James alluded to, what we could see in the next couple of hours is these final 19B4s being submitted. What's important to note here is that it's unclear whether basically all of the filers have heard this, whether we're talking about some, whether we're talking about all 13, because this is a very crowded race at this point.
It's a very crowded race, but at the same time, the SEC doesn't want to be playing favorites necessarily and giving any one issuer a lead, an unnecessary lead. What does your reporting show in terms of how they're likely to approve all these applications?
Exactly. That's exactly what we've heard as well, because that's what they did with the Bitcoin futures ETFs, which launched a little bit over 2 years ago. Of course, remember, ProShares got the lead start there. They have $1.8 billion in assets. A pretty much identical fund from Valkyrie launched a few days later. They have $34 million in assets. So they're trying to avoid a repeat of what we saw there. So again, the thinking and the consensus in the market is that this is a common clock, that they'd like to approve everyone all at once here. Whether everyone will be ready in time, all of these issuers, is the outstanding question.
Well, if you had to think about who would be ready and not ready, let's kind of go through the stack for a minute, because one matters maybe a little more than others, given there's already money in play. That is GBTC, that is Grayscale Bitcoin Trust. The discount has narrowed to only 6%. James, how much is at risk for their investors if they are not first out of the gate?
Honestly, I don't think much is at risk, because even if they're not first out of the gate, ultimately they are going to convert and that discount is going to be gone. Obviously, it's more at risk not for GBTC investors, but for Grayscale themselves, because if they're out in the first wave, they're almost de facto going to be the leader. We'd like to look at this market as it tends to be winner take most, and the people with the most volume tends to get more volume and dominate the space a little bit. Again, it's winner take most, so there's plenty of room for other people to be successful. But if they go out on the first day, they're at a pretty hefty head start at over $26 billion in assets. They trade over $350 million a day, both in assets and trading volume. They'd be in the top 1-2% of ETFs in the US if this were an ETF already. So that's as big of a head start as you could possibly get. So it's possible their situation is a little bit different from every other issuer because of the way that they filed the lawsuit, and they're filing what's known as an S3 rather than S1. There's some slight differences. So if there is a difference, it might delay them a tiny bit, but I think they're likely to go out in the first day, because if they're not out in the first day, or at least within a day or two of other ones launching, there's probably going to be another lawsuit.
And James, what's curious here is just how much attention that we're paying to every single filing. Every single update turns into this market-moving event. Is there any blueprint for that? Have you seen anything like this? I mean, we've had new asset classes come to the ETF wrapper before, but I can't remember when it has received this much attention.
Yeah, no, nothing. This is a one-of-one situation. We've never seen this much interest from people that don't really know much about ETFs or traditional finance, for that matter. People have become legal experts. I mean, I knew a lot of this stuff from a higher level. I knew some of it, but I've had to get way deeper in the weeds because our clients and just people in general are demanding to understand every step of the process of what's going on here. And it makes sense, really. I mean, people have been trying to launch this thing for 10 years. There's politicians involved. There's deadlines. There's billions of dollars at stake. Like, this is a big deal, and there's a reason there's getting a lot of coverage and interest from both the media and asset allocation perspective.
So once the SEC does approve the Bitcoin ETFs, and that's a when not if kind of question, and we've been deliberating on the when, how do investors figure out which Bitcoin ETF they want to buy? I mean, are we going to have a Super Bowl 2024 full of Bitcoin ETF commercials?
I wouldn't count out Super Bowl commercials for sure. I mean, we've already seen a whole bunch of issuers with their own commercials. I mean, we have Van Eck, Hashdex, Bitwise. Everyone's doing different things to market their own products. And like I said, it tends to be winner take most, not winner take all. So right now we're looking at 11 issuers. I don't know if there's room for 11 different spot Bitcoin ETF products, but there's definitely room for multiple. So some people are only going to care about the fee. They want the cheapest fee. That's how they're going to get exposure. Some are going to care about the brand name. There's undoubtedly going to be advisors out there that just trust BlackRock and that's what they're going to use, or Fidelity, or what have you. Some people are going to stick with Grayscale because they've been using them. Some might want a more crypto-centric offering from somebody like Bitwise or Hashdex or Valkyrie. And then there's people in the middle like Van Eck, and Invesco has partnered with Galaxy. So there's no way to know how this is going to play out. One of the other things I'm focused on is the issue. A bunch of the ETFs out there now, you don't actually see the on-chain address, so you can't see exactly where the Bitcoin is. Maybe some of the bigger issuers aren't going to release those addresses, so you can check it yourself to see if the Bitcoin is there. But some of these smaller issuers, I'd be shocked if we don't see a handful of these ETFs just saying, here, you can double check whether or not we have this Bitcoin that we say we have, because that's a huge concern in the Bitcoin world. They think it's going to be paper Bitcoin and not actually have exposure to Bitcoin. But I can pretty much guarantee you some of these filers are going to publish their Bitcoin addresses, so anyone and their mother can go on and look to make sure the Bitcoin is actually there when they say it is.
Certainly a lot to think about. Katie, the fees. At the end of the day, it's about money. I know it's about the technology, but it's about money too. Who has the most competitive fee structures, and how much might it really come down to that?
Fidelity. Fidelity is the low water mark right now. They filed that last week, actually exactly a week ago. 39 basis points is their fee right now, which really took a lot of people by surprise, because you think about some of the examples that we have in the ETF world. You think about GLD, the largest physically backed commodity ETF out there. It charges 40 basis points. So that 39 basis points fee was really interesting. But to James's point on marketing and how do you differentiate yourself, you also saw Invesco, for example, come out. They intend to actually waive their fee for 6 months, and then after that point, charge 59 basis points. So there's a lot of competition right now, a lot of creative thinking, and we haven't heard from anyone. We're still, from everyone rather, we're still waiting for BlackRock, and that's really a big focus, what the BlackRock fee will be.
Yeah, all these teaser rates, it's really interesting how it all comes down to just getting the people in, getting the money in while you can. All right. Katie Greifeld, thank you so much. James Seyfert of Bloomberg Intelligence, as we await more details on these Bitcoin ETFs. Coming up, big news this week from hedge funds, from Tiger Global to Bridgewater and Bobby Jane's highly anticipated fund. This is The Close on Bloomberg.
He's a star in the hedge fund world, though Bobby Jane is now offering steeper discounts for new clients as he prepares for what's expected to be the biggest ever hedge fund debut. Bloomberg's Hema Parmar reported on this and joins us now. What does it mean for him to make a move like this, and will it accomplish what he, presumably, wants to accomplish, which is a $10 billion fund launch?
Right, so bringing down fees to 10% for investors who give more than $250 million for perpetuity. Really interesting, because that's not something we see very often in the space. Guaranteed low fees, essentially forever. So you know, it's not always a great sign when a fund is reducing their fees to potentially bring in more clients. But also, this is a new fund launch, and he's 6 months in to his fundraise, and he has 6 more months to go between now and July when he's expected to launch.
So he has some time, and he's hired a ton of people. And you know, the other thing about this is, you know, you have that 2 and 20 in the hedge fund world. Is he putting a crack in it by doing this?
Well, you know, the 2 and 20 has been a bit outdated in recent years. You're seeing that come down over the years because new funds and emerging funds and smaller funds, they'll tend to bring their fees down to make it more attractive for investors to give them money. Also, you're seeing this growth in the industry across the space. And so you're seeing more options for hedge funds investors to get into. And so that has come down a fair bit in the past, say, 5-6 years.
And of course, Bobby Jane is the former co-CIO at Millennium as the Englander, so a big name in the hedge fund world, breaking off on his own. Let's wrap up all the big hedge fund returns from 2023 because the numbers and the headlines have been rolling in all week long. Let's start with the Tiger Cubs. We're talking Tiger Global, Coatue, Viking. What have we seen here? What's the common thread?
Right. So stock pickers are really among the better performing strategy this year when we look at the hedge fund returns. And Viking did about a 13% gain, Coatue about 21, Tiger Global close to 30, 29% for the year. A pretty good number. A lot of these funds were really helped by the stock market rally that we saw this year. But still, even if they came close to beating the S&P, they fell far short of the NASDAQ, which is a more tech-heavy index and the kind of things that these hedge funds typically invest in.
I'm looking at what we saw over there, and Whale Rock was up there at the very, very top with something about like a 59% return?
Yeah, strong returns for them. And the thing is, with some of these funds that are doing really well this year, it's a reversal from 2022. Okay. So a lot of these guys were down double digits in 2022. They're trying to recoup those losses, get out of that high watermark, and make money back for investors.
Right. I really want to emphasize that for a minute here, because even if you have Tiger Global with that almost 30%, you know, 28.5% gain, they had a really tough 2 years before that.
Yes.
So, and their private funds still have some issues to work through. You've reported extensively on that. If you're a Tiger Cub, is this your redemption yet?
Well, you know, Tiger Global still has to make 90% gains on top of what they've made so far. So the runaway to making up and recouping those investor losses is still far away, but it's not a bad dent.
Okay. At the very bottom of the pack, who's struggling here?
We're seeing Hadar, a macro fund, down more than 40%. We're seeing Bridgewater down a bit. We're seeing Schoenfeld, you know, not so bad, like up a couple percent, but not great compared to their peers of multi-strategy hedge funds.
Bally's
so you are
fascinating
seeing
too, guys.
Balyasny only a couple percent. So you are seeing some of the lower packs, macro, some multi-strategy funds. A bit of a mixed bag when it comes to macro. Other guys are doing really well.
All right, Hema, really appreciate your joining us. Hema Parmar covers the hedge funds for Bloomberg News, and it's always fascinating, Shonali, when you get to see these numbers at the end of the year, or I should say at the beginning of the new year, given how much movement there was in the markets this year and how last year, and how you could have really just sat in an index fund and did pretty well for yourself.
Yeah, that is certainly the story, and especially because some of those funds are highly levered, those index funds. The other thing is, too, we had to look at the year-end returns here because it will determine how investors put money to work in the future. And as we know, it's been a really tough fundraising cycle out there. Hedge funds are having their moment of reckoning.
Absolutely. All right, coming up, speaking of macro, we're going to get insight on what the jobs report says about hiring trends. Corey Kentenga is senior economist at LinkedIn, and he will be joining us next. This is The Close on Bloomberg.
I'm Shonali Bassick. I'm wanting to take a look on how the markets performed on the day because we got some relief in that stock market. We got the S&P 500 up almost 0.2% on the day, breaking a losing streak so far for 2024, but we do have it down on the week. We have a 10-year yield also drifting higher, now above 4% comfortably over near 405. You also had the U.S. dollar index facing some pressure toward the tail end of the day as we saw some softness in ISM data. The Dow Jones Industrial Average, NASDAQ, and the SOX Semiconductor Index all up on the day. Two-year yields, Scarlet, were roughly flat.
Roughly flat, but they were all over place during the trading day today. In fact, we saw a 17 basis point swing in a 130-minute span for the two-year yield between 8:30 a.m. and 10:40 a.m. or so. All right, let's get back to the labor market, which was the source of those swings, because the U.S. economy added more jobs than expected in December, 216,000 payrolls to be exact. So what does this tell us about hiring trends in the new year? Joining us now is Corey Kentenga. He's senior economist at LinkedIn. And Corey, just first of all, give us your take on what the jobs report did tell you or did tell us about the labor market and how that differs from what you've observed in the labor market.
So today's jobs report was solid. We saw solid payroll gains, we saw the unemployment rate remaining steady, and we saw inflation accelerate a bit, but it was still, a moderate pace. So overall, it was a solid jobs report. We're also seeing from this jobs report, looking back, including all those revisions, that the labor market has stabilized since about June. And we see that also in LinkedIn data. So hiring was up in December, but we saw the lowest year-over-year decline in LinkedIn data than we've seen all year long for 2023.
What industries in particular are you paying attention to? Because last year it was definitely all about big tech companies, right sizing, however you want to call it, right? Consolidating, year of efficiency, all of that. Are we still in the middle of that?
So tech is one of those industries that actually appears to have stabilized. Stabilized probably since the summer, maybe even a little bit before. So hiring in tech, as we see on LinkedIn data, is up about 12% compared to hiring overall, which is about flat. And there are a couple of industries that I'm keeping an eye on based on the jobs report. The first one is government. Government has added a lot of jobs, particularly at the state and local level. But this year, we're in an election year. There's not going to be a ton of spending. So if there's going to be a pullback in spending coming from the federal level, feeding to the state and local level, that's an area we want to look at because that's really buoyed job gains. And then also healthcare. A lot of healthcare has been driven by COVID spending and government spending. So there's been a pullback also in healthcare. We've seen bankruptcies increase this year for healthcare industries.
No, that's really interesting because healthcare was pretty strong in the December jobs report, right? If you strip out healthcare, the private jobs gain drops from 160,000 to about 100,000.
Right. So healthcare has been a strong sector this year. And if it continues to be a strong sector into 2024, we're going to expect to continue to see robust job gains. But if we start to see weakness in healthcare, that jobs payroll number is going to come down pretty quickly.
Curious about what you think about small businesses versus big businesses, because we did talk to a senior economist over at ADP, for example, and her worry was that small businesses could be taking more pain. You think about startups, for example, also more interest rate sensitive. Is it really just the big employers that are the ones that are able to maintain the strength of the job market, or is this more broad-based?
So what we've seen in the last year at LinkedIn is actually the opposite. It's been small businesses that have kept the job market afloat. It's been the big, large companies with over 10,000 employees that have pulled back the most. So it's really been small businesses. About 80% of businesses or more on LinkedIn are small businesses, but those have really been the companies that have kept the job market strong.
How important is that, too? You think about historically how many jobs the smaller businesses in America have created. And you think about maybe the challenges they have moving forward, the challenges in getting access to capital, for example. Why do they have an advantage in this market, do you think, versus those big businesses? Is there any sense?
Well, part of it is that the big businesses, they overhired during the pandemic. They went on a hiring spree and really gorged on talent. So right now for small businesses, the market has pivoted. It's become much more of an employer market. They have more leverage. So if you're a small business and one of the pains you've been having is recruiting talent, now is actually a good time to look at the market and see who you can pick up.
What we have right now is a bit of a pickup in M&A. There's a lot more deal making going on. Certainly we've seen it in the energy space. It's perking up in the healthcare space as well. And generally, a lot of companies do that because they want to reduce costs, and that often means job cuts. But within that, there's also opportunity as well. Can you talk a little bit about what a resurgence in M&A means for the labor market from where you sit?
So if you're thinking about M&A, two companies becoming a bigger company, some roles are going to be made redundant, but then some roles are going to be created. In a lot of the M&A that we're seeing now, you're probably hearing a bit of folks saying a bit about AI. We're going to use AI once we're a larger company, and we're going to use that to reduce roles or to enhance roles. Right now, there isn't really any expectation that AI is going to reduce the number of roles out there, but I imagine that that's going to play a big role in how a lot of these mergers happen.
How do you think about all the layoffs that we have seen in recent months into perspective? On one hand, we're seeing the backward-looking data look pretty strong, but what are you watching for in terms of signs of things softening further?
So one key thing with layoffs is when you look at hiring. So hiring is usually, they turn off the tap first. And then they see how many employees they have, and then they'll decide to do layoffs. So the key thing I'm thinking about right now for layoffs, which are, by the way, historically low. They're quite low. We are not in an economy where there's massive layoffs happening, despite what we see in the news. Layoffs are pretty low. But I'm looking at to see how many of these employers are holding on to their employees. So they're not hiring, employees are not quitting, so they're holding on to their talent just to see what happens. They may be waiting to see how 2024 is going to go to decide whether they need to hang on to a lot of employees or let them go.
Status quo, in other words. What about wage increases here? And I bring this up because obviously this is something the Federal Reserve looks closely at as a gauge for inflation, as a precursor to inflation, but also the complete benefits and the payment of, not payment of benefits, but the benefits that companies offer as a form of compensation. How does that picture change this year?
So coming up this year, I think we might see some movement in the package. So wage inflation is not expected to be what it was in 2023. There's a slowdown in demand, so obviously that's going to affect wages. But there's also a slowdown in supply. So in today's jobs report, we saw that labor force participation, employment to population ratio kind of ticked down a little bit. We may have exhausted labor supply. So when you don't have a ton of workers, that keeps pressure on wage demand. But with high interest rates, the economy slowing down, that keeps pressure down on supply. So the Fed is trying to do this balancing act of balancing supply with demand.
Funny, on LinkedIn, you see that New Year, New Job campaign going on. I've seen that happening. Yes. Thank you to Corey Kentenga of LinkedIn, where you could also find my newsletter every Friday. Keep an eye on it. Today we have
the shameless plug.
Oh, it's shameless, but it's the favorite thing I do every week. So continuing our conversation on U.S. jobs, where we'll talk a lot more about it in the next week or so. Larry Summers, the former U.S. Treasury Secretary, spoke with Bloomberg's David Weston earlier on his reaction to the data. Take a listen.
I think we're in the same kind of pattern we've been in for some time. As of right now, the economy looks pretty strong and inflation looks relatively under control. But there's a lot going on underneath the surface, and there are still substantial risks. I'm sticking with my three scenarios paradigm. Some risk of a downturn. We still keep not seeing it at all in the employment numbers. In the data on GDP, there's this big gap between total income and total output that makes things hard to read. And there's some worrying developments, some of the business surveys like that ISM, and in some of the credit data. So I think it's possible that the economy will go into recession in delayed response to monetary policy. That looks less likely to me than I might have thought some months ago. It's certainly increasingly possible that we'll have that much ballyhooed soft landing, as rare as those have been historically. And I think there's a risk that people are still underestimating, given the very worrisome fiscal prospect of the country, given the recent easing, quite substantial in financial conditions, given still tight, and the wage numbers, again, are not running right now. Today's number not running at a rate that's consistent with the 2% inflation target, given the uncertainties in geopolitics that could point to problems in supply chains. My gut is still that the market is underestimating the inflation risks in the current situation, and therefore probably overestimating the amount of Fed cutting that is going to take place. but it's a fairly close call, and the Fed is certainly doing the right thing by being entirely vigilant and signaling that it is very much going to be data dependent going forward.
And coming up, we're going to hear more from Larry Summers, the former U.S. Treasury Secretary, up next. It's a wide-ranging conversation. Stick with us. This is Bloomberg.
It's time now for our Wall Street Week Daily segment. Host David Weston joins us now. Larry Summers is a regular guest on Bloomberg Television, a regular contributor to Wall Street Week Daily. You talked with him, obviously, about the jobs report, but he has a lot of thoughts about what's going on in higher education right now, given his previous role.
Yeah, exactly, including as president of Harvard, as well as being a tenured professor at Harvard even now. And so we asked Larry what he thought about Harvard now, given the fact that we do have the resignation now of President Gay, something he didn't call for, but he had criticized what had been going on up there. And he basically put it in a broader context, saying this is an awful big problem for universities all over the place, and maybe some of the trustees should pay attention. This is part of what he had to say.
I think this is a time of testing for universities, certainly unlike any other, certainly since the Vietnam War period, and perhaps even going beyond that. Some of our leading universities are under investigation, both from Republicans in the House of Representatives and from the Education Department of the Biden administration. You're seeing a degree of divisiveness on campus that I haven't seen since I first got to the Harvard campus in 1975. So I think there's going to be a very profound challenge of finding a vital center. Universities must stand up to some of the vitriolic forces on the populist right that seem to be in favor of everything up to book burning in support of enforcing some very particularistic vision on universities. At the same time, I don't think there's any question that they have been threatened from within by stifling orthodoxies that have led to the cancellation of speakers, that have led to people being discomforted by discussing issues like crime, like education, except in particular prescribed ways. And it's going to be the challenge of university leaders to find a way between those twin abhorrent poles. I have to say that this goes way beyond any individual. I think universities have, in many cases, including at Harvard, been failed by their trustees. At Harvard, we call the group the corporation. And in many ways, it is their job, above all, to maintain a healthy interface between the university and the broader society as they select leadership, as they manage the university's affairs, as they set messaging on the most fundamental topics like free speech of the university. And I think that there's going to be a need for accountability of trustees in a way that I have not seen in many, many years. Because I think after all of these problems, issues that have arisen, whether it's the way in which preparation for testimony was managed, or it's the choice of leaders. These are things that trustees have controlled at many universities, and I think in different ways at different schools, trustees are going to have to be held to account for what has been an extremely difficult period.
That was Larry Summers, former U.S. Treasury Secretary, and listening to him, this is a really hard problem, and it makes you wonder who would want to be president of a university, or by the way, listening to Larry, who wants to be a trustee these days, because it's a lot harder. At the same time, you have children, I have children, we're trying to get them ready for life, and we would hope that the university would help them get ready for the real world.
Absolutely. You know, it just strikes me, a university president needs to be much more than an accomplished scholar, right? They really need to be a politician when it comes down to it.
Yeah, in part because we've politicized so much of our society. There was a time maybe there wasn't that much politics on campus, although I must say, going back to when I was on campus back in the 70s, there was a lot of politics. But at the same time, if you think about it, so much of our society has become so political, it's so polarized one way or the other, and it's permeated the entire society, including our university. But as I say, that's part of the job now. It's a different job, and it's a hard job, but that's we're trying to get our kids ready for the real world.
And I was thinking of when Larry Summers talked about also the trustees need to be accountable. That's kind of what Bill Ackman, who claims a lot of credit for leading the ouster of Claudine Gay as president of Harvard, is pushing for. He wants a change over at the Harvard Corporation, the Board of Trustees.
Yeah, he's sort of demanding it. But as you say that, you're absolutely right. Need to be accountable, but to whom? You know,
to the donors, or
exactly. It's not clear that we should be accountable to the donors. We had Scott Bach on, the fellow who stepped down as president of the Penn trustees last week on Wall Street Week, and he said, look, the donors should give money or not give money. They shouldn't get to decide what goes on at the university. We do have trustees who should be responsible for that, and the president should be accountable for them. But it's a little bit a question when you say the donors get to decide what's being taught on campus.
For real. Okay, now Scott Bach was a previous guest on Wall Street Week. Who do you have coming up today?
David Autor, who's a professor of economics at MIT, and he's done a lot of early important work on generative AI, specifically on what it's going to do to the labor market, where there are opportunities and where there isn't. And the thing I like best is, he says traditional computing is sort of like classical music where you play the notes on the page. Generative AI is jazz.
Oh, nice.
It's improvising. You don't know where it's going.
Oh, interesting. That's a really good analysis of that. And of course, MIT's president's still in place for now, Sally Kornbluth, right?
But a lot of questions are being asked now about MIT as well.
All right. And of course, that is at 6 p.m. Eastern Time, Wall Street Week with David Weston. Still ahead here on The Close, what investors need to watch for tomorrow and next week. This is Bloomberg. All right, the big thing to watch for in coming days, a major storm in the U.S. Northeast. Let's bring in Brian Sullivan, who covers weather and energy for Bloomberg. Brian, are we talking about a rainstorm or a snowstorm?
It depends on where you are. And if you're in New York City, it's a rainstorm. But if you go about 20 miles north or west, it's a snowstorm.
How much of a rainstorm are we talking about in New York City? Are we talking a drizzle, or are we talking everything that would have been snow in Central Park coming down on us?
Yeah, it'll be rain. It'll be high winds. There'll be some slush thrown in, maybe a little ice as well.
Oh, that sounds lovely.
I mean, the big thing here is that New York hasn't gotten snow in, 2 winters, I feel like? So
yeah,
this could break the record.
It's been a long time. They broke a record last winter for the longest it was before there was any kind of measurable snow. And I think when they did have measurable snow, it was maybe an inch and a half. I don't know. It wasn't much.
Well, in some ways, is it better that we are seeing snow, given that it's been pretty unseasonably warm this winter?
You know, it's good if you're trading natural gas. You want to see this, but for the rest of us who are paying the natural gas bills, yeah, I don't know.
Yeah, well said. So how are cities, how are states preparing for this? Because since it's been a while and we know that the infrastructure here tends to get overwhelmed by weather events.
Well, Amtrak has already canceled a number of trains out to Harrisburg and Roanoke for tomorrow, and then they canceled a few trains going up to Boston on Sunday. Boston should get hit a little harder than
All right, Brian Sullivan, really appreciate it. Brian Sullivan covers weather and energy for us in Boston, giving us a little bit of a sneak preview into what we might expect in the coming days with this snowstorm or rainstorm. Anyway, we do want to look ahead to next week, Shonali, because the first week of 2024 is in the books, and now is when, all the cobwebs are out of the system. Everyone, kind of got back into the swing of things, but really next week is when things begin. More data and earnings.
You know what's amazing about that is I know a lot of people that are still trying to take vacations, but guess what? Next Friday is the start of earnings week. I am feeling that pretty hard right here because you have 4 major banks reporting that day, 2 more coming after a long weekend holiday, where a lot of bankers are also going to Davos, but also there is more economic data, CPI, PPI. You have inflation prints, all with the backdrop of volatile energy prices. So a lot of questions about inflation.
Absolutely. You mentioned bank earnings at the end of the week, but Jefferies reports on Monday, and that gives us kind of a sneak preview into what the banks will say about the capital markets side of the business, the trading business, the investment banking business, just a little bit, right?
It was the year of the consumer, or so they say it was supposed to be, or supposed to be this year. Rates coming down. Maybe you want a loan. Maybe you want a mortgage. I don't know. I don't want any of the above.
Perhaps. And we also have Fed Speak. Don't forget, you've got Bostic, you've got John Williams, you've got Neil Kashkari. They will all opine on where they see things headed when it comes to those, 5 or 6 interest rate cuts that the market's still pricing in right now.
Yeah, and into that week, yields drifting higher, 404 on the 10-year, if you could believe it, Scarlett.
Yeah, 404, but then just as quickly it can come down, as we've seen. That does it for us. Balance of Power is up next. Have a great evening. Have a great weekend. For Shonali and myself, this is The Close on Bloomberg.